Doesn't look like a tumble, certainly at this point. It looks like a fairly mild move to the downside as we price in some of the corporate news that we've been getting. We'll get to the details of that in just a moment, and that kind of arbitrage story with the United States from yesterday, that sell-off that we saw into the close. So here we are, FTSE's down by actually 0.75%. That's maybe a little chunkier move to the downside that we were anticipating. Well, certainly when I got in first thing this morning. But the FTSE MIB's down by 1%. The IBEX is down by a similar sort of amount as well. Stock 600 opening down by around half of 1%. We'll get a price on the DAX very shortly. The other factor in the mix this morning, Anna, is we've got a lot of ex-dividend stocks in the market as well. So that's a factor that is going to certainly weigh maybe on the downside as well.
Absolutely. The team has provided us with an exhaustive list of all the ex-dividends. I will save everybody and I won't read through all of them. But just to point out the likes of AstraZeneca, BP, just a couple of them that catch my eye. NatWest, Pearson, there's some really big names in here. Unilever, Standard Chartered, so some big names, and that will have an impact. In terms of those sectors then, that said, around ex-dividends, most sectors are in negative territory, Guy, and that goes along with the extent of the losses that we're seeing across European equity markets this morning. So we're down by 0.5% now on the stock 600. Basic resources is the worst performing, down by 1.3%. And this is nice for us because it takes us back to one of the conversations we were having right at the top of the last hour around base metals and around weakness there, around recent weakness in copper prices. So Anglo-American, Glencore, both of those a little weaker. Concern around the US growth story, concern around the Chinese growth story as well. So that's the basic resource space. Banks also weaker, technology also a little bit weaker. So some of those high beta sectors losing a little bit of ground this morning.
Understandably. I think we'll maybe give it half an hour or so to settle this market down, get through some of the kind of the pricing around the States, figure out exactly how we're going to deal with some of these corporate news elements that we need to factor in as well this morning. So kind of single stocks, we've kind of worked our way through some of those. We've given you an idea of what is happening with the sector story this morning. We've priced in the United States. Where do we go from here? Eleanor Lee, fund manager at Polar Capital, joins us now, where she manages the Melchior European. How do you say that?
Melchior.
Melchior.
Right.
That's been my morning. Believe you me, I've been almost right all morning, but not quite. How's the week gone for you? Where are we in this process? We've seen obviously a big volatility spike at the beginning of the week. We're kind of unwinding that a little bit. But are we going back to a low volatility environment? Are we going back to an easier operating environment that we've seen this week? Or are we in a different paradigm, do you think?
I wish I could say we were going back to an easy environment, but I don't think that's the case. I expect the environment to still be quite volatile, but perhaps not the levels that we saw on Monday. I mean, Monday, there were signals of panic. The VIX went above 50.
Yep.
Last time we saw that was in the pandemic. And there was a lot of volatility in stocks, which created opportunities. So I don't expect us to go back to that level of volatility, but I still think there's a bumpy road from here. Clearly, the market is trying to force the Fed's hand. The labour market's been weakening,
yep.
And the market wants the Fed to cut rates.
Rise to the rescue.
Yes, exactly.
The danger with that is that if the Fed does rise to the rescue, that it may be perceived as showing that there are signs of weakness in the economy, which is bad for risk assets. So is the market kind of caught between the devil and the deep blue sea here?
Well, I mean, the labour market is slowing, so the good news is that the Fed actually has the toolbox to respond to that. I think, if the Fed came out and gave an emergency rate cut, that would be a sign of panic.
Yep.
And that is not my base case. But I think the market would be reassured by the Fed taking into account the recent data that we've seen, the slowing in the economy. It's not been uniformly negative data, as we saw with the US ISM this week, but clearly there is a slowing, and there needs to be a response to that. So the good news is that they have the toolbox to do that. They have room to manoeuvre,
yep.
And I expect them to do so.
Eleanor, good morning. Does it feel, though, talking a lot about feelings and emotions in the markets this morning, does it feel like a market that needs 50 or an economy that needs a 50 basis point cut, or would 25 suffice? Given the weakness, yes, you're talking about the weakness we've seen in the data, but given the extent of that weakness, does 50 seem overdone?
Well, I think there is a view that if the Fed had the labour data, a week earlier, that they would have cut in July. So by doing 50 in September would be more catching up with that. So going from being behind the curve to potentially, getting on the right side of this. So I think the market will be looking for 50. 25 would be seen as disappointing. Having said that, though, they will be looking at the complete picture. So in terms of the labour market, we know that some of that data can be prone to revisions. There's been talk about if there were some one-offs, weather-related. So I think they'll be looking at the complete data set as they should before they make a decision.
Thinking about the volatility we saw at the start of the week, and you said that there might be more of that to come. I mean, JP Morgan saying we're about 3/4 of the way through unwinding the yen carry trade, which is quite a big an achievement. It's been a bumpy ride, and some things have got broken along the way. What else are you looking for to give you a steer as to whether we're through this bout of volatility?
Well, the yen carry trade unwind was obviously one of the unwinds we've seen, but there's also been just broader unwind of a very crowded positioning since mid-July, since earnings season began. So I think we're looking for valuations of some of those crowded trades to come back to more realistic levels, and some positioning in that to unwind. But it's already gone quite some way, having been happening since the middle of July.
And so that's where we are at the moment. I'm just looking at US futures sort of weakening a little bit as we speak, and the European equity market picture looks weak. We thought that was just catch up with yesterday, but now if US futures are weakening, we're sort of flat now, having priced in earlier some moves to the upside. What do you think? So we've talked about some of the things in the driving seat, the carry trade and the unwind around other positioning. What do you think the earnings season is telling us about where these markets go next, or is it just not really about the earnings story at this point?
No, I mean, I think it's very much about the earnings season, but it's also more about the outlook. So in Europe, earnings season has actually been slightly better than expected, but that hasn't really mattered if you look at what's happened to stocks. There's been a very negative skew to earnings, so the price reaction, as you've seen, has been quite violent in some reports, and I think that's because the outlook has softened, and that's really what's mattered the most. On the back of earnings, we've had a more muted outlook, negative revisions. So it's not really been about the earnings themselves, but that outlook which has softened.
So what do I do? It gets to the end of this week. Been a huge amount of volatility. We've calmed down a little bit. Do I get back to being risk on? Do I go back to buying stocks? Do I go back to buying tech stocks? What do I do at the end of this? And is that in any way different to what I did before?
I think you have to. Our base case is that there will not be a recession, but clearly the risk of policy error and misstep has increased.
Right. So that's less risk. So I take less risk in that kind of environment?
I think you have a balanced portfolio. So
right.
In terms of extreme moves like we saw on Monday, there was clearly an opportunity there to pick up some stocks, some very high quality stocks. I'll take, for example, ASML at one point on Monday was down 30% over the last 3 weeks on an intraday move. It was below its long-term average multiple. So moves like that are extreme, and that creates an opportunity. So I think you have your shopping list of high conviction stocks that you want to add to on periods of volatility, but also be cognizant that the data is slowing. Having a bit more defensive exposure is also attractive.
A balanced portfolio has underperformed recently. Is it going to outperform in this period of higher volatility? If I haven't been in the top 10 tech names for the last year, my portfolio has done worse than the market.
Yeah.
Is the new environment better for a balanced portfolio?
Well, I think if we move into a coordinated rate cutting cycle in the second half, that could help to have more breadth in the market.
Right.
That's been part of the problem, is that there's been an extended period of concentration in the market over the last 18 months. But rate cut cycles can actually be a prelude to having some broadening in the market.
So if we're going into rate cutting and we are alert to weakness in the global economy, I'm looking at basic resource stocks down the most today, worrying about China, worrying about maybe the possibility of a US recession as well. Overlay on that some of the sort of longer term themes that investors are thinking about, and I think here about AI and the opportunities there. How resilient can AI themes be if we see that cyclical downturn? Do you think this is something that persists through the cycle, or no, very vulnerable?
Well, I think we're positive on AI, and we think it's a disruptive technology. I think there's been a healthy dose of realism in some of the pullback and in some of the questions that are being asked about the CapEx spend. But we're still at the very early innings of what is a long-term structural trend. So I would still expect those stocks to do well, and that AI enablers should have a place within your portfolio. The use cases for AI are, we're still at the early days. There'll be more products launched in the second half. And we should get more confidence about that AI story being monetized as time goes on. But it's still very early, and I think the market is punishing some stocks, expecting that killer app to already be realized. But if you think about it, ChatGPT was launched less than 2 years ago.
Yeah.
I think the expectations of the killer app already being in place are a bit too...
Yes, because it feels like, unless you're NVIDIA or one of the other fortunate and well-placed chip makers, it's not been a revenue driver yet. It's been a big cost line. But so when do we pivot to this becoming more than just this sort of cost and a concern about capex into something that really delivers? What kind of timescales are we talking about?
Well, you've seen in the US, some companies like ServiceNow upgraded guidance because of better traction from their AI products. But I think there will be a broadening of that trend. As I said, with more products being launched in the second half, but in a 12-month plus time frame. And companies are now realizing that, I think Capgemini CEO said it best, that AI is not a silver bullet. Now they're actually working on use cases, being more disciplined about where they can, drive revenue and cost savings from AI.
Am I more focused on the States still, or am I happy to invest in Europe? If we're going to see a more diversified story, does that bring Europe back into play?
I think Europe, the starting point is extremely attractive, relative valuation discount to the US, even if you exclude the big tech stocks, it's on an almost 30% discount to the US, so it's an attractive point. The rates cutting cycle has already begun in Europe, so it's ahead of the US, potentially ahead of the curve. And it is very sensitive to rate cut cycles, so both from the consumer and corporates are very sensitive to rate cut cycles, so should tend to do well in a rate cutting environment.
Lovely to see you this morning.
Yeah.
You're thanking.
Thank you very much. Eleanor Lee, thank you. The fund manager at Polar Capital. Now time for Guy's Core 6.
My turn. Okay. Let's look at the Core 6, see what's happening. These are some of the big stock stories around Europe that we continue to watch on a daily basis. We'll get to the kind of the movers of the day in just a moment with Joe. But as you can see, there's a lot of red on the screen this morning. Novo Nordisk, one of the few stocks to be posting gains. But as you can see, LVMH, Ferrari, ASML, Schneider, Nestle, all in negative territory this morning. So the big heavyweights in Europe seeing a little bit of weight to the downside this morning. What else are we watching? Joe, you got the details.
So one of those heavyweights declining, Guy, is Siemens. Now, this stock was bouncing around pre-market on the Tradegate exchange. They are warning of too much inventory on their automated warehouse business. They have upgraded some other businesses, including the software unit, looking pretty strong. But it does look like the automation business weighing on that, down 1% at the moment. In terms of Rheinmetall, it's already up around 400% over the past few years. So we're not seeing much movement, actually just ticking lower now. Strong earnings once again, though. Deutsche Telekom and Allianz, the other two big German stocks among many today. Deutsche Telekom, of course, owns a big chunk of T-Mobile in the US, and that is doing pretty well at the moment. Allianz, PIMCO strong, a bit of softness in some of their insurance business, but overall a pretty strong report from them. And there's a bunch of other insurance stocks with reports out today. Zurich, the surprising at week one. Now, there are some analyst notes around some certain capital issues at the company in terms of their report today. But the earnings, again, overall, the life insurance business, as Anna was discussing earlier, does look pretty strong. But that is a surprising underperformer today. Munich Re out with numbers as well. And the Lloyd's of London insurers, Beazley. Now, there was concern that this company has heavy exposure to the recent software outage, the outage that disrupted My Holiday. But Beazley gaining 10%, reporting better than expected numbers, surprisingly for that firm, maintaining their outlook. And Lancashire is the peer on that stock as well. They've also got numbers out. Both of those Lloyd's of London firms moving higher this morning. In terms of some other earnings stragglers to bring you, Nordic Semi, the semiconductor firm, they have actually had a series of profit warnings, but today inline guidance, giving that one a bit of a relief. Deliveroo and Entain is takeaway food and gambling, to our favourite sectors. Now, both of these boosted by the Euros. Of course, us England fans do want to forget about that as quickly as possible. But Deliveroo actually doing a £150 million buyback, something you wouldn't expect to see from a company that has been unprofitable for a long time. And Entain, a massive boost in their earnings from the Euros. A lot of England fans losing their bets. That's good for the bookies. And Sandoz, finally, over in the pharmaceutical space, the generics business spun out of Novartis a couple of years ago, getting my pharmaceutical companies mixed up. But they have actually reported some weakness in some of their pricing today, so that one is declining at the moment. A quick check on the home builders. Redrow's takeover by Barratt potentially might get approved if they can fix those local concerns from the CMA, but actually a bit of weakness in those markets today. And Persimmon also had numbers upgrading its guidance. Potentially the Bank of England rate cuts will help that stock as well once those come through into the mortgage market. Finally, a couple of morning calls to bring us away from the earnings and M&A. Now, Glencore actually reinstated buy at Citi. That's after their coal business was not going to be spun off, according to the update yesterday. Citi actually think that's quite a good business, given the exposure to the steel sector. And finally, one more to bring you is BP downgraded at HSBC. This is the second downgrade for BP in 2 days. We yesterday had RBC. The buyback issues are easing. One thing to note, though, there are some ex-dividends on these stocks, as Anna was mentioned earlier, but that stock is 1.8% lower in London today.
Joe, thank you very much. Joe Easton from our equities team. Joe was telling us about the house builder M&A earlier, Guy, and the intentions there and the CMA objections. I do think if the most that the CMA could find to object to is one area of 10,000 people and a lack of competition as a result of this deal in that space, then, you know, you think there'll be remedies that maybe the business can present. And the business sounds confident it can present those. And
there's going to be a huge amount of pressure to build houses.
Yes.
And that is going to represent some huge challenges. Is a consolidated sector better at delivering on the targets that the government is going to set? That is an interesting question. Is it better at investing in the kind of technology which is going to deal with some of the labour shortages that we're going to be seeing? That, I think, is an open question. So I think there's a kind of bigger picture story here, which is going to be really interesting to kind of roll into how the CMA thinks about it.
Yeah, and sticking with the UK, he flagged Entain as well, just worth mentioning that the Entain move up 8% or so, just shy of, and Flutter being lifted on the back of that. That's the only sector, travel and leisure, and it's very much that leisure bit that is lifting markets or providing the only upside to markets, I should say, in what is otherwise a pretty down day. Coming up, another stock that is moving to the downside. Siemens sees demand for software and electrification products despite weak factory automation sales hitting returns. We'll bring you Guy's interview with the CEO. We'll get into some of the really interesting detail here because the market responding negatively in the near term, but actually pulling back from those losses, now just down by 0.2% as the market has a lot to read through when it comes to these Siemens earnings this morning. This is Bloomberg.
Bloomberg has enhanced search on the terminal to deliver what you need when you need it. Now, you can simply type phrases in everyday English in the command line. Compare financials. Find people. Analyze markets. You can enter phrases or ask questions. What do you want to know today? Ask a question or visit SearchGo to find answers now.
Good morning. This is Bloomberg Surveillance.
Welcome back to the opening trade.
This is Bloomberg Technology.
This is the Asia Trade.
You're watching the close. Welcome to Balance of Power.
This is Bloomberg. Welcome to the world of decentralized finance.
With a surge in Bitcoin, you have crypto stocks also surging.
Bloomberg's covering all things crypto, the people.
This is a political attack, and we must hold our elected officials accountable.
The transactions.
Really a record-breaking moment.
Bitcoin is the exit strategy.
And the technology.
Awareness is going to grow, and these things grow the overall industry.
Crypto as an asset class is here to stay.
Bloomberg Crypto, only on Bloomberg.
Or other authorities.
Could face bigger challenges.
Britain's next. It was going to keep winning World Cup. This is a 3
as the economic picture
covering the intersections of Hollywood, Silicon Valley, and beyond.
Lots happening on Wall Street.
I couldn't have been more wrong.
It's going to stay volatile for a while longer.
It's a bifurcated market.
Need to catch up?
This is Bloomberg Wall Street Week. I'm David Weston.
We've got the information and insight.
Year over year, you could start to see some cracks.
It might be overhyped short term, but it's underhyped long term.
From businesses most influential and instrumental.
A lot of the doom and gloom has been somewhat overblown.
If you're not living near the edge, you're taking up too much space.
Bloomberg Wall Street Week, only on Bloomberg TV and radio. Context changes everything.
We are quite happy with that quarter. It was driven basically by another very strong quarter of smart infrastructure. Our electrical business grew by 21%, but we also had a very strong software business. The underlying the software business was very strong, but we also had a couple of wins, large wins. They don't repeat in that size again, but this helped quite a bit also in drive our top line and bottom line as well.
Donna Bush, CEO of Siemens, speaking a little earlier to me this morning after the numbers dropped. And the market can't make up its mind on this one.
No, really can't.
So we've been all over. Pre-market, we were up.
Yeah.
We opened down. We've come basically back to flat. It's a real kind of. The reason it's difficult to read is that automation is clearly a problem. They've talked about the fact that they're basically, as a result, their guidance, which is on the revenue line, is 4 to 8%. They're probably going to be at the low end of that. But the market kind of had already.
Yeah, the market was at 3.5 anyway,
Precisely.
wasn't it? So that was the thing that stuck in my mind. Yeah.
So this is better. So automation is clearly still a problem, and there's a whole kind of destocking process. So industry basically needs to come back and start buying more stuff for that process to work. But on the other side of things, the software business is doing quite well. You've got other areas of the business that are performing quite strongly, and the margins there look fairly strong. He's not overly concerned about a recession either, which I think is interesting too. So broadly, actually, I think it's a fairly well-balanced business, and that, I think, is why the market is struggling to kind of get a sense of direction here.
And you do get a sense that even as things are worsening a little bit at the margin for European sentiment this morning, we're now down by nearly 1% on the stock 600, in fact. As that's happening, the Siemens share price is actually on the rise, so we're pretty flat on Siemens now, coming back from earlier losses of more than 1%. So that's where we are on Siemens. Another share price that is outperforming a little this morning, up by 0.6%, of 1%, is the Rheinmetall share price. This is the defence business, reporting weapon and ammunition sales for the first half of the year that beat estimates, margins coming in higher than anticipated. We understand very well, sadly, where a lot of the demand for these products is coming from, but there's a lot to talk about here when it comes to this sector. Let's bring into the conversation Bloomberg's Laura Alves, who's in Frankfurt for us. Laura, good morning. So how did Rheinmetall fare then in the second quarter, and does it tell us a broader story about the defence industry in Europe?
Yeah, so the second quarter for Rheinmetall has once again been a really exceptional quarter. The CEO has referred to what's happening to the company at the moment as an accelerating super cycle. So he says that he's never seen that kind of growth before. The company has doubled their profit. They have increased sales by half. So you can really tell that this defense ramp up in Europe is very much still ongoing and that there is a lot happening in that space. The company is targeting around 10 billion euros in sales this year, which is also unheard of for a German defense contractor up until this moment. And in addition to that, with Rheinmetall, all eyes are on backlog as well, which is, of course, a big discussion in the defense space as a whole. Their current backlog is at over 48 billion euros, and this is probably going to swell to around 60 to 70 billion euros by the end of this year. So you can really tell that there is no shortage in orders and no shortage in interest in Rheinmetall's products.
The CEO was recently at the center of an assassination plot. What does that tell us about how critical this company, this sector is in terms of the war in Ukraine and Europe's efforts to defend itself? The fact that there was a plot against him specifically speaks maybe to sort of just how critical these companies are. Any misstep, even marginal, could cause problems.
Yes, absolutely. Like, the plot was against him specifically, but it was also against defense chiefs more broadly. The plot against him was the one that was the most mature. It was foiled by US and German intelligence services. It was a Russian plot. And what this really tells us is that this is another facet, and that defense companies are really being pulled into another facet of this hybrid war that Russia is waging at the moment, with, for example, cyber attacks, espionage, and so forth. And these assassination plots against defense chiefs are really another part of that. And of course, with regards to Rheinmetall specifically, the situation is currently being closely monitored at all times. Pappberger is receiving special protection at the moment, but of course, the situation remains very tense.
And what is Rheinmetall's role in Ukraine at this point then? What do we know about that, Laura?
Okay, so what's happening there is that they're really intensifying cooperation with Ukraine, and they're also trying to set up more operations within the country itself. That includes a tank repair hub that was launched in June in cooperation with a Ukrainian defense contractor as a joint venture. And the CEO also announced that they will be producing the Lynx combat vehicle within Ukraine itself. And secondly, of course, another major focus point for Rheinmetall is ammunition. And they are setting up an ammunition plant within Ukraine as well. They just received their first order for technical equipment for this ammunition plant, and output is supposed to start in the next 24 months. So there is really a lot going on within Ukraine itself in conjunction with Rheinmetall as well.
Laura, thank you very much. Laura Alves there with the latest on the defence sector. Coming up, we'll get back to market dynamics and specifically around corporate debt. Corporate debt issuance rebounding in the middle of this week after it was sort of frozen at the start of this week. We'll get the thoughts of Omotunde Lawal from Barings, who'll be joining us shortly. We saw that 17 companies in the US raised a lot of money in terms of the primary issuance market, and almost having a negative impact on what was going on in Treasury auctions as well. So that is where we find ourselves in a rather strange week for corporate debt. We'll put all of that in context. We'll talk about risk and how these markets are absorbing risk right now. This is Bloomberg.
The names that move markets are on Bloomberg.
How worried are you about the U.S. election? It's for the American people to decide what they want with their politics, with their government, with their future. But obviously, we are all concerned about it because the United States is the largest economy, the largest defense country in the world, and has been a beacon of democracy with all its upside and downside. We cannot interfere with their choice. It's their choice, and that's the beauty of democracy. But we have to be extremely attentive and anticipate, just as we do with inflation. You know, we do scenarios. What if, what if, what if? Then what do we do? Where I sit now in Frankfurt, head of the ECB, I think that we have to be strong as Europeans and not assume that we can rely on whoever our friends are around the world, because these things change over the course of time, as we have seen.
Bloomberg. Context changes everything. From our studios in New York and San Francisco, our expert hosts have the data and analysis about the companies you know and the startups to watch, plus the interviews you don't want to miss. Watch Caroline Hyde and Ed Ludlow on Bloomberg Technology, the only daily business show dedicated to tech, right in the middle of the trading action, every weekday, only on Bloomberg Television. Context changes everything.
Access the financial world on demand. Hear from leading economists, policymakers, and industry experts via live and on-demand webinars, only only from Bloomberg. Start exploring to see what's moving the markets. Visit Bloomberg.com/webinars.
Bloomberg covers the world with unmatched reach and resources. From more than 120 countries, the moment news breaks, 24 hours a day. Bloomberg, context changes everything.
Welcome back. This is the opening trade. 30 minutes into Tuesday. No, let's not go back there. Thursday's session. We are down by just over 1% on the Stock 600. The FTSE kind of on par with that, really. The CAC 40 is also weaker. They're all down by around 1% or so. US futures have worsened a little bit after an attempt to go higher a couple of hours ago. Let's talk about what's going on in corporate markets, though, corporate debt markets. Volatility at the start of the week had a chilling effect on global primary corporate debt issuance, but it didn't last long. Yesterday, 17 blue-chip companies offered nearly $32 billion of debt, the highest US investment-grade issuance that we've seen on any day this year. What's happening in these markets? I'm pleased to say we're joined by Tunde Lawal, head of EMEA Corporate Credit and Emerging Markets Corporate Debt at Barings. Tunde, nice to have you with us once again in studio, and we like to we'll turn to you to understand exactly what's happening in this corporate debt market, because it does seem to have been a week of huge volatility in some assets, and to some degree that filtered through, certainly in terms of that primary issuance story. Talk to us about what we've learned this week from this market action.
Right. So we woke up on Monday morning thinking, "Oh, Black Monday," and it really was just, you couldn't do anything. You were just transfixed, because you could see bond prices being quoted down, you could see spreads being quoted lower, commodities were lower. And as the day went on, I'd say probably lower beta stuff was maybe 5 to 10 wider on Monday, and the higher beta stuff, the more high-yielding stuff, was quoted anywhere from a point down to 4 points down, depending on where you were. And all new deals stood down, so all primary deals stood down, as you would expect. But I think as the narrative sort of started to come through in the day, where people are ascribing some of the weak non-farm payroll data to weather issues, as well as some disruptions, and actually cautioning everyone that back in April, we did have a jobs number that got revised down materially, and then in May, we had a doubles, and we didn't panic. You know, we had a doubling of payrolls. We didn't panic, so why are we panicking on one number and calling for emergency meeting? And so some sort of normality started to return into the market on Tuesday. We saw that sort of correction back on Tuesday. We started to see things maybe snap back 30-40% of the way back. And then yesterday, there was a bit more of a recovery, although less so than Tuesday, where we saw the recovery. And yesterday, as you said, was the biggest year-to-date supply day in the US IG market. On the EM side, there's only one deal that's priced so far this week, which was China aluminium.
So it's been a big week. There's been a lot happening.
There's been a lot.
What does it tell us that we got that big issuance yesterday from all those US corporates? Was it just because nothing happened on Monday and Tuesday, and so it came through? I mean, it seems to be a sign of risk appetite returning a little bit after what happened on Monday.
Well, yes, because if you look also at what the commodity prices were telling us, actually we don't think we're headed for a hard recession in the US. And so everyone's sort of getting back to, well, I want to de-risk. If I've got funding needs, I want to de-risk ahead of US elections. And we're coming back to the whole, well, the world's going on. Yes, it's slowing a little bit, but it's going on. And even corporate earnings, we're in full swing of corporate earnings season as well. None of the corporate earnings that are coming through is telling us we're headed for a hard landing in the US or a recession. So corporates are just getting on with business as usual.
Let's park the triple Cs for a moment. Do we go back to the same spreads that we had before Monday? Is this a reset? Has something changed? Do we just go back to this huge demand, this almost insatiable demand, it felt like, that we've had for credit?
Right. So prior to Monday, corporate spreads were in most asset classes at almost all-time tights, if not all-time tights. Everyone's talking about how spreads are really tight. But it was less about the spreads. It was about the all-in yields as well, right? And this was the same messaging we had for clients was, yes, spreads. So if I quote the JP Morgan Corporate Index, the SEMBI Index, for example, spreads were at sort of record tights for decades where we were. We were at 200-ish, very, very low 200s. But it was less about that. Now we're sort of back around the sort of 240 level. On the IG side, we're around the 140. On the high yield side, we're about the 440. Do I see us going inside of 200 on SEMBI? Probably not, because again, when I look at where spreads are versus how much tighter they could grind, I think there's probably not that much room because a lot of credits are priced to perfection where we are now, and none of it is really factoring in what sort of volatility we might get to second half of the year. And so I think returns will largely be driven by what we get in the risk-free rate for the second half, and probably spreads don't go inside of where we were before. So I think we'll recover some of it, but probably not going inside of where we were before.
Okay, let's talk about the second half. If I listen to a lot of the bank calls, the sense seemed to be that actually there's been a bit of pull forward on issuance, primary.
Correct, yes.
Does that mean, how much lighter does the second half look?
So on the EM side, for example, I think the call for full year gross supply is somewhere around the 440, 450 billion. I think we're punching close to 300 here now at the moment. Yeah. And so really a lot of that has sort of printed in the first half. So second half,
most of it, yeah.
Exactly. So second half, even though we may or may not get Fed rate cuts, I think corporates are thinking, well, if I've got a window now, I must come to the market now and sort of lock in these rates that I can get, where you've got windows of stability in the risk-free rate. And I think investors like us on the other side are thinking, well, I want to lock in these higher coupons here and now. So there's a bit of a sort of marriage of convenience going on in the first half. Second half, where we don't know what's going to happen with geopolitics. We don't know what's going to happen with U.S. elections. And we really don't know if we might get a resurgence of inflation in second half, which some people are calling for as well. So there's all sorts of unknowns for second half that if you have a window in first half, you should take it. And people are taking it.
Yep.
All the more reason then to quote this nice acronym which you introduced me to in your notes, Tunde, today. I'd never heard this one. I've heard of FOMO, but I've never heard of Omijom, which 1 month is just one month. I mean, so taking us back to the sort of underlying story in the United States, as we wait for all of that geopolitical uncertainty to play out, we're back to thinking about the Fed and back to thinking about the underlying performance of the US economy and whether we do get a soft landing still, or whether a hard landing could lie ahead. We get claims data later on today.
It's a big day for claims data.
Right. Is it going to be a big day? Is this a day where we could be spooked in the way we were on Friday?
Well, I think everyone's looking for the next data point to sort of hang their hat on. And what we've been saying is you shouldn't look at just one data point and freak out on one data point.
You look at two and then freak out.
Well, let's hope we don't freak out today.
Let's hope.
But yes, certainly I think there'll be a lot more scrutiny and a lot more interest around today's initial jobless claims. And then next week, we've got obviously CPI and retail sales data, which again gives us a better sense of what's going on underlying whether the Fed really, truly does have a reason to do something.
Okay, let's talk about the Fed. What signal would you take? What signal do you think the market would take if the Fed delivers a 50 basis point cut? Is that we're just playing catch up, we probably should have cut in July, we didn't, we're delivering kind of two together? Or does the market go, something's going on here, I need to be worried about this. The Fed's cutting 50 basis points, I need to be worried.
I'd be in the latter camp of if they do a 50, then that tells me they're seeing more than we're seeing and they're worried about something coming.
The 50's a hard landing?
50 for me is something's not quite right.
Yeah. 25's a soft landing? So
25's a business as usual. We kind of telegraphed we may or may not do 25. If inflation plays ball and all the prints are showing a softer landing and all of these sort of gradual slowdown, 25 is to be expected.
So big rate cuts don't signal risk on necessarily?
No. Because again, it's really about what's driving that.
Yeah.
You've mentioned commodities a few times in our conversation, and what commodity prices are doing at the beginning of the week. And I mean, maybe that's because some of the issuance is coming from that space. But I wonder what clues you're getting from that market, because geopolitics perhaps supporting prices to some degree. Certainly if you look at oil, that seems to be some of the chatter there. But then we've got base metals actually having a pretty tough time, in danger of, I think, on one of the LME indexes, of erasing all of this year's gains. I mean, what weakness does that signal?
So I think after Monday's move, I think you've sort of had commodities sort of recovering ground, oil prices, even copper, zinc as well. We've had some of the commodity companies releasing numbers in EM. Structurally, I think things like copper, iron ore, lithium, that are metals that are essential for the green transition. I think people structurally are quite constructive of them. I think we generally as a house are constructive on copper. Yes, we are getting some swings where people fret about China slowdown or not China slowdown, and that does give you some sort of tremors within copper prices. But I think structurally everyone's still sort of supportive copper prices, and I think for us we are constructive copper prices.
So when is this? Okay, let's wrap this conversation up. We've had a massive week waiting for claims. We'll see what claims tell us a little bit later on. Are we in a new place at the end of this week than where we started this week? Are we going back to what we had before, or are we seeing something new and different that we need to adapt our portfolios to?
We all feel a little older, that's for sure.
Yeah, more grey hairs. No, I would be in the camp that no, because nothing in the corporate earnings that we're seeing coming through tells me we're headed for a hard landing just yet. Yes, there is a slowdown in pockets, and yes, we've been hearing about subprime segment weakness in the US for some time. We're hearing about, even some of the Mexican companies, when they report numbers, they tell us they're seeing some softness in their US markets on sort of basic stuff like confectionery and bakery goods and things like that. So there is some softness in some segments of the US market. But are we in a different place where...
So why did the market freak out?
Why did the market freak out on Monday?
Is it just the payroll number? Is it just we haven't had a correction for a while? Is it... I don't know. I'm still trying to put my finger on it.
I feel it's the payroll number. I think it was the magnitude of the miss on the payroll number that spooked everyone, and the fact that spreads were just already at quite tight levels, and everyone's freaking out thinking maybe the Fed's made a policy mistake and maybe they haven't. But actually, you get a data point. If we get a data point next week that shows that actually inflation is firmer than was expected, then we're probably back to where we were, where we're thinking, well, maybe actually the Fed doesn't have any cuts this year.
Wow.
Maybe.
Okay. That would be quite a round trip.
What? Exactly.
Yeah, we've gone from emergency rate cuts to...
And to just answer your other question is, why did the market freak out on Monday? Remember, it's August.
That's also
Most
true.
people are on vacation somewhere. So we're running a very light bench already, and you get that sort of big miss in payrolls, you get exacerbated moves, which I think is also partly to blame for what happened on Monday.
What are we doing here?
Well,
you should be on holiday. That's what you should be doing.
I'm glad you're here, because at least you can update us on what is happening.
We'd have no one to talk to if it weren't for you, Tunde, so thank you very much.
Tunde Lawal, Head of EMEA Corporate Credit and Emerging Market Corporate Debt at Barings. Thanks very much indeed. Not on holiday. Maybe soon. Anyway, after the recent global market meltdown, the Markets Today blog is currently holding a Q&A session with its in-house experts. If you want to get some answers to your questions, maybe I should be tuning into this as well. You can do so on your Bloomberg terminal. You can also do it on Bloomberg.com. What have we got coming up for you? We're going to switch focus. Anti-racism protesters have turned out in their thousands across the UK this week. Didn't see it last night, though. We're going to discuss if social media platforms can be held accountable for spreading misinformation. We're going to talk about that next. This is Bloomberg.
Also an owner, I should have pointed out, of 3 major sports teams.
That's right.
And you're the first woman, as I understand it, the first woman to own 3 major, have stake in 3 major sports teams. Is that right?
Yes, and we'll say African American.
You were approached by the owner then of the, I guess, the Washington Wizards and the Washington Caps about maybe buying the Washington Mystics, which is the women's basketball team. And what did you say?
Well, first of all, it was Abe Pollin. He did come to me and Susan O'Malley, and they said, Abe Pollin says, look, I want you to be the face of the Washington Mystics. And I said, what do you mean be the face of? He says, I want you to buy this team. His health was failing. And I have to tell you, and a lot of women can understand this, we never get these opportunities. So that was the first thing that struck me, and I was flattered. I was really flattered. I said, well, Abe, what are the financials on this? And he handed them to me. He says, well, they're not making money. But I was still intrigued about team ownership.
Billionaire Gautam Adani founded one of India's biggest and most controversial business groups. After being rocked by accusations from short seller Hindenburg Research last year, Adani is now preparing for the company's future in a real-life succession story. Meet the family members he's handpicked to take over the business as we deep dive into the facts and rumors surrounding the Adani Group. Inside Adani, a Bloomberg exclusive, premieres Friday only on Bloomberg.
Welcome back to the opening trade. Sentiment seems to be slipping a little this morning. We're down just over 1% on the Stoxx 600, and it would be tempting to think that that is just catch up with the trade of yesterday in the United States, where we saw that big Whipsaw Wednesday event and markets closed weaker after initially being much stronger. Well, now you look at US futures and you wonder if that is the case or whether there's something more negative afoot, because E-mini's down 0.4%, as are NASDAQ futures. So sentiment, it seems, just ebbing a little bit as we go through the early hour of this European session. Switching focus away, though, from markets and to some of the politics that has been playing out here in the UK. Thousands of anti-racism protesters rallied across the UK last night following more than a week of rioting by far-right groups. This comes after UK Prime Minister Keir Starmer warned social media firms over online misinformation and toxic content that fueled the unrest. Let's get some analysis of the role that social media firms are playing here and the extent to which they are being regulated or not, with Palmy Olson from Bloomberg Opinion, who has been tracking this story. Palmy, good morning. How much has online misinformation then contributed here? Give us a run through of the role that it has been playing in the recent violence.
It's definitely played a significant role in the violence. Some analysis has traced some of the misinformation back to one news story on a site called Channel 3 Now, which after the Southport attack and named the alleged attacker as a Muslim asylum seeker. And that could have been the end of it. The problem was that story got screenshotted. It went viral on X, formerly known as Twitter. Influencers like Andrew Tate told his more than 9 million followers that the attacker was an illegal immigrant. And then Nigel Farage went on and cited that in TV interviews. So it really was just this kind of cycle of increasing the virality of this misinformation at a really tense time. And that just went on to cue these violent attacks on mosques and refugee housing. So it really could have just stayed as it was, just a little news story, but it was the virality of this misinformation spreading on X and also on other sites like Telegram, TikTok, which just became a big problem.
In theory, the UK's got new legislation coming into force, which originally conceived was designed to deal with some of these issues, but has largely been defanged, or certainly was defanged by the previous administration. If the new administration, the new Labour government, were to put some teeth back into this legislation, how should they do it? How could they do it?
Yeah, it's a great question. And, you know, I have to say the online safety law that was initially designed by the Conservative government was a very cleverly designed law to thread the needle of free speech. It took inspiration from health and safety law and said that tech companies have a duty of care to their end users. And essentially, it's not it gives Ofcom, the regulator here, the power not to go after content or even individual users, but to assess the systems and processes of tech companies and hold them to account, audit them, and make sure that in times like these, as we've just seen over the last 2 weeks, that they don't allow misinformation to spread. But as you say, the problem was just in the later stages of the law being passed, it was watered down. A very important part that made legal but harmful speech was removed. Legal but harmful material was removed, so that it only covers illegal content like calls to violence and hate speech. So all the online misinformation that we've seen, the stuff about this attacker being an asylum seeker or having this particular name, which was completely incorrect, that is all fine under the current law. So as far as what the Labour government can do now, I mean, the law is as it stands. So they're going to have to, if it's possible, to look at ways at addressing what's in the legislation. Maybe that's something they can do. But I think what I understand from speaking to Ofcom, speaking to people who designed the act, is the best that the government can do right now is just engage with these companies, which is exactly what they're doing. They're having meetings. They're pushing them to really just be transparent about their misinformation policies and enforce them, because that's the problem. A lot of this misinformation goes against their own rules, even on X, but it's just not being enforced properly.
And Palmi, is part of the problem that, they're trying to engage with these social media platforms, but the boss of one of them is actually getting himself involved in this. I mean, to what degree do you think there will be attempts to limit what Elon Musk is doing? He's clearly with somebody with a lot of influence, and what he says goes a long way. But on the other hand, if he thinks to him a civil war looks likely, should he be able to say that? I mean, clearly we didn't see that happen last night. What do you think the government's intentions toward Musk will be?
I think it's a very tricky balance, because Elon Musk is essentially being an internet troll right now. He is just poking Keir Starmer, calling him two-tier Keir. He is making these very incendiary comments about the UK being on the brink of civil war, absolutely not helping, breaking his own rules of his platform. But on the other hand, the government has to be careful that it isn't drawn into this war of words with Elon Musk and essentially legitimize his authority in this whole situation. So I think it's a very tricky situation, because actually if you look at Twitter's audience numbers and active users, that has been going down ever since Elon Musk took over. So yes, it is a very influential platform, but is it as influential as it was a number of years ago? Not as much. And so I think there's a very tricky balancing act that Keir Starmer has to make here, in terms of addressing what Musk is saying without giving him too much credibility and authority as an influencer. I mean, at the end of the day, Musk has 190 million followers, so something has to be done, but it's going to be very tricky in how they address it.
Palmi, we're going to leave it there. Thank you very much indeed. Thank you very much indeed for the piece. Useful insights into what is happening here as we watch it from multiple angles in the UK. Palmi Olsen joining us from Bloomberg Opinion. Busy day.
Yes, we've got jobless claims. Let's say that again, shall we? 1:30 p.m. UK time. US initial jobless claims. And the reason we mention it a few times today is because the market was so spooked on Friday by the payrolls number. This is also going to tell us something about the US labour market. And the last time we got this data, and it is weekly, of course, and so weekly data can be very volatile, but the last time we got this reading, it was the highest since 2021. If we get something that looks like that again, does that spook markets?
To your point, it's weekly data. It's very choppy, therefore can be affected by kind of near-term factors. Clearly, some of the weather-related events in the United States affected the data, we think, probably in terms of the payroll number, and has been affecting certainly the claims data as well. I wonder how clean this number is going to be in terms of what it tells us really about the situation in the labour market. Yesterday's 10-year auction didn't go well. Does the 30-year auction go any better?
Yes, and it's interesting you put the claims number in the sense of how clean is that data going to be. I wonder how clean the auction is going to be, because the fact that we got so much corporate issuance yesterday, as we were discussing with Tunde earlier on, we got so much corporate issuance that maybe diluted appetite for some of that Treasury demand. If that's not the story today, if we're not seeing a whole catch-up on the week in terms of corporate issuance, then maybe the Treasury auction looks different, but we'll have to see.
Maybe it goes slightly better. It was really disappointing yesterday. I think it caught a lot of people on the hop. Tom Barkin's going to be speaking a little bit later on, Richmond Fed President Thomas Barkin, so we'll get his take on kind of where we are. It's interesting to get this Fed speak, given the speculation around whether or not the Fed is going to have to deliver outsized rate hike, 50 basis point hikes. CPI data out of Mexico, we've got that later as well. I think we've got a rate decision out of Mexico as well. And the corporate story continues. So you've got Paramount today, which I think is interesting, Expedia as well. Lilly's going to be fascinating, given particularly the misstep we saw, the marginal misstep, but it was exacerbated in terms of the share price move we saw around Novo Nordisk. So it's going to be interesting to see what they're saying in terms of their production capability to deliver some of these GLP-1 drugs into the market.
Yeah, is there any such thing as marginal when it comes to these businesses that are so priced for perfection in the views of some and so huge on the European corporate space? So Zepbound is the Eli Lilly contribution to this particular space, to the obesity space, and it has had supply shortages, which is something we've seen from some of the other providers in this sector. But the CEO has recently said over at Eli Lilly that they'll come to an end soon. So any update on the supply story at Eli Lilly is certainly going to be one that we're watching very closely.
In terms of the movers thus far, I think the house building story is interesting. I think Siemens is all over the place. I've seen it up, down. I think it's down again now.
Down again, now down 0.5%.
But to your point, the market's also lower, so you need to factor that into your thinking as well. There's a lot of ex-dividend in the market. The insurance story this morning, I think, has been really interesting. We've heard from Munich Re. Zurich Insurance has been a really interesting story too. Some really positive stories there, particularly coming on through the fee business, which is much more sort of understandable and manageable in terms of the story there. So some really interesting corporate news coming up. We've also got some great guests lined up throughout the rest of the day.
Yeah, absolutely. We've got the Robinhood co-founder and CEO Vlad Tenev joining us later today. So that conversation 3:30 UK time. That could be an interesting one. Yeah. Back to where we started the program, then, guys. So we had Monday mayhem, turnaround Tuesday.
What have you come up with?
No, I'm still waiting. I'm still thinking. Which or Wednesday? Well, it's only 8:56, so I feel we've got time. But this time tomorrow, we'll have a descriptor for Thursday, some alliteration. It all looks a bit gloomy right now, doesn't it? I mean, US futures.
Doesn't work. Gloomy doesn't work.
Gloomy Thursday doesn't work, so we need a gloomy word that starts with a T. We have an entire team of top producers working on this endeavour this morning. Yeah. I hear whispers in my ear. None of them loud enough though to help me out.
We will come up with some decent names. I think it does hinge on the data a little bit later on.
Yes.
I think that's going to be really interesting, and how that is going to likely inform what we're going to see. So in a few minutes' time, Francine's going to be joining you for the pulse. What we'll do there is give you some of the early trades in terms of the single stocks. We'll get some pre-trade. In terms of US futures, this is what the picture looks like right now. We actually, when I first came in this morning, US futures were looking fairly positive. That has rolled over a little bit. Anna's been making that point throughout the morning.
Torrid. Thank you, Assad. Torrid Thursday so far. We'll see how it turns out. Thanks, everybody. This is Bloomberg.
Fixed income fix. Watch Bloomberg Real Yield every Friday right here on Bloomberg. Context changes everything.
DOJ or other authorities
could face bigger challenges.
Britain's election was going to keep Rain World Cup. This is a three
as the economic picture
covering the intersections of Hollywood, Silicon Valley, and beyond.
Bloomberg has enhanced search on the terminal to deliver what you need when you need it. Now, you can simply type phrases in everyday English in the command line. Compare financials. Find people. Analyze markets. You can enter phrases or ask questions. What do you want to know today? Ask a question or visit SearchGo to find answers now.
Bloomberg Surveillance covers the latest in global markets and the political events that influence your world. Join Jonathan Farrell, Lisa Abramowitz, and Anne-Marie Hordern only on Bloomberg. Context changes everything. Welcome to the world of decentralized finance.
With the surge in Bitcoin, you have crypto stocks also surging.
Bloomberg's covering all things crypto, the people,
This is a political attack, and we must hold our elected officials accountable.
the transactions,
Really a record-breaking moment.
Bitcoin is the exit strategy.
and the technology.
Awareness is going to grow, and these things grow the overall industry.
Crypto as an asset class is here to stay.
Bloomberg Crypto, only on Bloomberg.
European stocks slip as volatility grips global markets, while weak demand for treasuries weigh on sentiment in the U.S. JP Morgan says there's an increased chance of a U.S. recession this year. This, as it estimates that 3/4 of the global carry trade has now unwound. And in the U.K., anti-racism protesters turn out in their thousands to counter far-right demonstrations that failed to materialize, while as Britain probes possible foreign government involvement to incite violence online. Now, good morning, everyone. Let's take a look at the European markets map. This is the picture for this Thursday morning. We've had a lot of volatility, and certainly markets on and off some of the lows and highs that we've seen today. Now, a lot of the pressure is coming back. The CAC 40, 1% lower. The FTSE also down by a similar amount. The FTSE MIB over in Italy, 1.4% lower. Now, the focus firmly on what we're going to see in the U.S., and that's the U.S. jobless claims. And then, in general, of course, markets have been very turbulent in the last 4 days because of this economic data last week. That fueled worries over the strength or weakness of the U.S. economy. And then there's more and more divergence play between what the Fed does and the BOJ going forward. S&P futures down 0.4%, and then we'll have a good conversation with Amrita Sen on oil and gas, Brent 78.24. So for the conversations that matter and the insights you need, let's get started. Good morning, everyone, and welcome to the Pulse. I'm Francine Lacroix here in London. So European stocks, as we were saying, dropping, prolonging this volatility on global markets as investors turn their focus to U.S. jobs data due later today. And let's bring in Sophie Huhn, senior cross-asset strategist at BNP Paribas Asset Management, and, of course, our Noor Al-Ali, MLive strategist. So thank you both for joining us. Noor, what a week. We've made it to Thursday. I don't know how much more traders can take of this. I mean, it's just all over the place.
Yeah, and they are looking for reasons to panic, Francine. And I think when you think about it that way, you'll understand why potentially maybe the bottom isn't here yet, right? We've got jobless data later today. That's a massive risk event. You know, the auction for the 10-year yesterday, also the demand was quite weak. It's just not the kind of dynamic that's going to see those buy dippers, you know, coming back, coming back to the market. So I'm not too optimistic this morning.
Sophie, what are you seeing out there?
I think it's could be an opportunity to buy on dips, especially on cheap assets. I think we got a perfect storm a couple of days ago. Market illiquidity during the summer, no to soft landing price to perfection, a couple of very crowded trades. Now, I think there's been an exaggeration. We're nowhere near a recession yet. So having a more balanced portfolio and tilting towards like some cheap value assets makes sense.
So what do those look like? And again, I think we had JP Morgan saying, look, about 80% of the carry trade has been unwound.
Yeah.
What more is there?
I think it's not how much left, but it's how orderly it's going to be. I think going forward, we're going to have a much more orderly unwind of the carry trade. I don't think we should continue to pile into it if you want to take a bit more risk. It's better to focus into, for example, shorting the dollar, being long the NOK versus sterling, you know, the cheap value risk tilt you want from there.
And I guess, Noor, I mean, Monday was ugly, right? That's probably the understatement of the year. But a lot of the focus was on AI stocks. It was on Warren Buffett. What he was saying is, of course, that jobs report from the U.S., but it was also the carry trade, BOJ, and earnings. What's the panic or the concern about right now? Is it mainly U.S. focused, which is why those jobs numbers are so important today?
Look, Francine, two opinions make a market, right? Sophie sees an opportunity to buy the dip. I think maybe we're not at a bottom yet, but you do see that a lot of the rotations that we've seen, so into the overnight action, turnaround Tuesday was something that a lot of people was hoping that would carry through. And actually, TV's Markets head Dan Curtis had a great point yesterday where he said the gains that we saw on turnaround Tuesday were actually funded by real estate stocks, by financials. So those are the kind of sectors that show you, well, maybe potentially those concerns over the economy are a little bit overblown. We do know that the economy is potentially slowing. After all, that's what interest rates do, right? You tighten so much that you hope that demand is subdued to the point that inflation does ultimately go back to target. The question here now is the Fed and the BOJ and the RBA as well earlier, which actually said, we're considering raising rates now. It's not even a question of that. But markets have continuously, I would say, bullied central banks, as John authors say, because they have aggressively bet against what policymakers have said time and time again. And a lot of these traders have found themselves on the wrong side of the trade because central banks have just gone the opposite directions. Now, for the RBA's example, for instance, RBA says, look, we might even raise rates, but markets are actually betting that the next move is down, and they're expecting that we'll potentially get a cut from them in December. That divergence creates a lot of opportunities in the markets, and that's where you would come in and find those pockets of value in the market. But so far right now, that global story of an economic slowdown, particularly from the U.S., while China's also struggling, is a big concern. And in this dynamic, I don't see those gains holding through.
Yeah, bullying is a strong word. I mean, I feel like central banks have been very tentative because they also have skin in the game because it's all about their reputation. Sophie, when you look at some of the other things, of course, equities versus bonds, actually they behaved in the correct way. Some could argue that this week. Where do you see opportunities? I mean, is it geographically or is it really cross assets?
So I think, what you said about equity and bonds, the fact that we're going to get into a more negative equity bond correlation basically give opportunities to add a little more risk in the portfolio. Where we see opportunities, Chinese equities, I think the expectations are so low. They are boosting consumption. They are even what you saw over the past week, they outperform other markets. So at a time where, as you said, global central banks are going to start their easing cycle, investors are going to start looking for cheap, long-duration exposure, and Chinese equities are one of them.
So how do you play Chinese equities, like actual in China, or do you go for some of the big companies in Europe with a lot of exposure to China?
The problem with European equities at this point is they are a bit more expensive than Chinese equities. I think where the expectations are very low is more on the Chinese side. What could be supportive for both Europe and Chinese equities, though, could be the restocking cycle, as well as front-loaded orders ahead of the tariffs.
What do you do with BOJ right now? The million-dollar question, or?
I mean, it really is very interesting, right? They raised rates, and then come Tuesday after the market meltdown, the deputy governor came out and said, well, hold on, if there is such a rout in the markets, as we've seen on Monday, maybe we won't, policy is actually not going to be it'll still be accommodative. We won't be tightening in the pace that markets have suddenly reacted to. And I think it's quite interesting, right? I mean, the last decade in Japan is quite interesting. Dealing with deflation is so much harder than dealing with inflation. And now Japan is dealing with a completely different thing than what its policymakers are used to. It's a completely different dynamic. And so I would say that even policymakers themselves need to have that time to assess all the economic data that's coming out and to also see how their economy, particularly Japan and its appeal, I mean, the Japanese currency is basically like the world's third largest or most traded currency as well. So there's that global exposure in Japan that's really weighing there. And so I would say that maybe time is the best answer, but traders don't look to be looking to wait.
Yeah, I mean, we talked a lot about Warren Buffett and the fact that he's, taken stuff out of Apple and gone to cash. And we have a story today saying, look, if you look at Berkshire, it has large stakes in 5 Japanese trading houses. They've lost so much that it could present another opportunity. Do you like Japanese equities?
I see dollar yen at 130 at some point. And Japanese equities, I think it's maybe time to shift into small caps versus large cap because they're going to be less exposed to the currency exposure. I think the Japanese story is still there. The corporate governance reform is still ongoing. Now it's more trying to navigate what's going on outside of Japan versus like the idiosyncratic fundamental story in Japan, which is still solid.
I mean, the other big conversation this week is, does the Fed have an emergency meeting? Do they cut even this week? Some saying, well, this would cause panic. But I see a lot of the big banks, of course, now raising their risk of a recession. Yeah. I think JP Morgan was the last one at like 35%. What's your take on what the U.S. economy does?
I think it makes sense to price a bit more recession priority. We shifted from no lending, soft lending. At this point, having a bit more tail risk into your baseline scenario makes total sense. I don't think we're on the verge of recession yet. If you look at the OECD leading indicator, we're currently in expansion. The next phase is slowdown. Jumping into recession right now on one data point is a bit overstretched, I think.
I mean, 35% chance is high.
Yeah, it's very high, right? And look, the thing about a recession is when it happens suddenly and it happens fast. And a lot of the data that we currently have, or the measures that we look at economically, is pretty much lagging data, right? Like, so you need to look at a basket case of readings and several readings, as Sophie points out, to see whether or not the economy is stalling. But look, Francine, the pandemic, the AI rally, the boom, there's just so much that's changed in the economy since 2020 that it's been an incredible stretch of run, especially for the U.S. economy, which has held up against a lot of the uncertainties that's been thrown at it. So a little bit of easing or cooling is to be expected. The Fed has had its most aggressive tightening cycle since the 1980s. Inflation is still above target. Services, wages inflation. Home buyers are really now starting to feel that pinch. Demand in the U.S. for the housing market is still quite low and subdued just because of how the mortgage market is set there. So I see a bit of easing to go in. How far that recession goes, it depends on whether or not the Fed is perceived to be behind the curve or not, right? And so that's really important. Right now, the markets think, yes, they are, right? If you look at market bets of where the Fed is expected to go with its policy towards by December, we're seeing about 100 basis points of cuts. So that's either 250 basis points cuts or 225s and then 150. That's a big step up in expectations versus just months ago when we thought maybe September's in play, potentially November. Now, though, I'm really excited about Jackson Hole.
I'm excited about Jackson Hole. Something always comes out of Jackson Hole quite big, and then I do feel like market expectations have been, frankly, all over the place for the last 18 months on Fed. So if you from BNP Paribas Asset Management and Noor Al-Ali, MLive strategist, both stay with us. Now, coming up, European gas futures jump on reports that Ukraine has seized a gas transit point just inside Russia. We'll look at how prepared the region is for supply shocks. This is Bloomberg.
Lots happening on Wall Street.
I couldn't have been more wrong.
It's going to stay volatile for a while longer.
It's a bifurcated market.
Need to catch up?
This is Bloomberg Wall Street Week. I'm David Weston.
We've got the information and insight.
Year over year, you could start to see some cracks.
It might be overhyped short term, but it's underhyped long term.
From businesses most influential and instrumental.
A lot of the doom and gloom has been somewhat overblown.
If you're not living near the edge, you're taking up too much space.
Bloomberg Wall Street Week, only on Bloomberg TV and radio. Context changes everything. It's a multi-trillion-dollar industry. We'll show you what's happening in ETFs like no one else. Bloomberg ETF IQ, Monday on Bloomberg. From our studios in New York and San Francisco, our expert hosts have the data and analysis about the companies you know and the startups to watch, plus the interviews you don't want to miss. Watch Caroline Hyde and Ed Ludlow on Bloomberg Technology, the only daily business show dedicated to tech, right in the middle of the trading action, every weekday, only on Bloomberg Television. Context changes everything.
Welcome back, everyone. Now, still with us, Sophie Yoon, Senior Cross-Asset Strategy at BNP Paribas Asset Management, and Noor Alali, MLive Strategist. So thank you both for sticking with us. Noor, we talked a lot about the Fed expectations. How does that translate into BOE?
Well, look, the BOE just cut rates. The Fed didn't. So we're off to a great start when it comes to the easing cycle for the Bank of England. The BOE looks to be, or at least the markets are expecting them to adopt a much closer pace of easing to the ECB's, which is a cut, pause, and potentially cut again. So we are expecting that the Bank of England potentially cuts again, maybe once or twice more by December. We're still, we're still not in full consideration there. But in terms of the UK, inflation is at target. We've got a new government. The stocks are still undervalued there, so there's a lot of room for them to gain. But when it comes to bonds here, I think maybe they won't really beat treasuries, because if we're expecting the Fed to cut a lot more, I expect that potentially the bond market moves to adopt a similar, slower pace of returning back to their average that we've seen in the past couple of years.
So do you think the Fed cuts a lot more? It has to cut a lot more? Or, again, it seems that a lot of the data points are all over the place in the U.S.
I think we need a further unwind of U.S. exceptionalism that is still embedded into U.S. asset prices. If the Fed were to cut at a faster pace and come to neutral, so the Fed is expected to go to neutral around end of this year, January, around 3%. If the cutting pace is going to go faster, I think it's possible. But on that side, I think it's the major trade we want to put on is a short dollar.
What does that mean for ECB? I mean, again, I feel like there's this gravitational push from the Fed that every central bank is pushing back against that, but it must make a difference.
So it's very interesting, because if you look at the 3-year, 1-year forward rate, the ECB is already allowed to decouple from the US to settle at 2, which is not the case for other central banks with the Fed. They might follow and cut at the same pace.
All right, thank you both for joining us. Sophie Yoon there from BNP Paribas Asset Management, and Noor Alali, our MLive Strategist. Now, European gas prices have surged to the highest level this year following a report that Ukrainian troops have seized a key gas transit point near the border in Russia. Meanwhile, oil has also had a recovery rally after its sell-off at the end of last week. Now we're joined by Amrita Sen, founder and director of research at Energy Aspects. Amrita, thank you so much for joining us. I've been dying to talk to you all week on this macro meltdown. And actually, if you look at some of the forces influencing oil prices, where do we go from here at a time where, again, macroeconomics is very uncertain?
Yeah, absolutely. And, thanks for having me. I was looking forward to this as well. So, look, I think oil's very much been swayed by the macro factors right now. But I think in the grand scheme of things, if you look at some of the other market corrections, oil's really held its own. And that's partly because oil's own fundamentals are stable. Stocks are drawing. That's exactly what should happen this time of the year. Over 1 million barrels per day of draws, kind of June, July. It's slowing down a little bit now because of refinery outages, but generally speaking, it has been drawing quite substantially. Also demand. I mean, if you look at some of the revisions made by the EIA for April, May, I mean, these are huge upward revisions, particularly to U.S. gasoline demand. Doesn't show us that things are falling out of bed at all. Yes, there are pockets of weakness, China being one of them, but overall, pure oil market fundamentals are okay. It's just much more a sentiment-driven sell-off, and oil, of course, is a part of that. That's why we're below $80 for crude. But I'm not expecting a meltdown like some of the other asset classes we've seen.
But, Amrita, again, I guess the market is on edge over this possible retaliatory strike by Iran on Israel as payback for some of the assassinations of the Hezbollah and Hamas leaders. We've been waiting for that. Is the market going to be tight until we get something?
Yeah, and I think that's a very fair question, that how much of this kind of quote-unquote geopolitical risk premium is in the price? Is that why crude hasn't fallen further? I don't think there's a lot in there. There's definitely, lots of chatter, lots of rumors around imminent retaliation, and to your point, hasn't happened yet. There are some headlines and warnings it could happen today, or at least kind of today or tomorrow. I think, yes, the market is expecting that, but at the same time, nobody is really expecting a big outage to oil facilities. Of course, miscalculation risks are high, and Israel has in the past kind of attacked Iran's oil depots just as a warning shot that, look, we can if we wanted to attack your infrastructure. I think everybody is trying not to get there. Those risks are there, but that's not the base case for us or for most people. So I think, I actually don't think right now there's a lot of geopolitical risk premium in the price. If anything, Libya, and we've seen a force majeure yesterday on one of the big 300,000 barrels per day field, that's probably a bigger focus for crude in particular, because again, that's much more of a Brent crude equivalent and has been supporting time spreads.
Marita, we're also seeing the possibility of this hurricane-related disruptions in the U.S. especially. So what does that mean? Could we see oil in the mid-80s?
I absolutely think that late summer, we have been talking about a rally, we're holding that view, and that's still the case. Hurricanes can act both ways, right? If you lose refineries, that could mean less crude demand, but of course we lose products as well. So you do get, gasoline and diesel prices going up. But if you lose production and ports, then yes, it does support crude prices. In general, we had a very early hurricane. And if, again, we get an increase in hurricanes, then we are expecting to lose barrels overall, whether it's crude or products, and that does tighten up the balances. So there are those risks, right? Weather factors, Libya, geopol generally, those will kind of keep the market, or keep people from shorting crude significantly.
But overall, so you see this balance of supply and demand remaining healthy, right? I guess for maybe apart from a bit of weakness from China, the rest seems pretty much balanced. Is that fair?
I think it's balanced. Healthy is a relative term. We're not saying that, we are screaming bullish and we've run out of crude stocks, but it is healthy in the sense we are drawing. That's exactly what is to be expected. I think right now the focus for everybody, oil traders, analysts, it's that 2-year treasury yield, right? Like that's a signal of what is the Fed going to do. Our macro guys have maintained for a long time that it's going to be 2 rate cuts. We are now expecting 3, but it's still 25 basis points, right? Because for us, we are saying this is an orderly slowdown. We've been expecting this slowdown. The oil markets have been signaling this slowdown for a lot longer than equity markets have been. So we've been warning about this, but it's also not a macro meltdown. There are very specific factors that's distorting the US macro data, Beryl being one of them, the IT outages being another factor. So I think the market's in a bit more of a panic mode. Again, not saying demand is growing by 2 million barrels per day. It's more like 1 million, but equally, it is not contracting. So I think there just needs to be a bit more, a bit less panic and a bit more calm, and then people will realize that things are pretty stable for oil.
Amrita, what's your take on gas? So again, these European natural gas prices have resuming gains, which is frankly a nightmare for some of the central bankers, yes. Not only Bank of England, but of course the ECB. And this is on, they're trying to monitor the transit of Russian fuel across Ukraine.
Yes, absolutely, and we kind of highlighted and put out a note yesterday on this very factor. And look, generally speaking, European gas is pretty well supplied. And yes, this outage, of course, adds to that. And again, both for crude and for gas, the market has been quite short, and that's why you kind of see the outsized moves that you see on a daily basis because of that. But it's not like 2022 or even kind of 21, when we had that acute shortage. There is ample gas in storage. So it's not that we are expecting a kind of tripling of prices from here. We've seen the move up. And yes, of course, that does put, basically gas has to go up to kind of cold switching levels. Otherwise, that's the only way to balance the market.
But Amrita, right now, again, this natural gas flows via Ukraine are continuing. What happens if this ever stops?
What happens if it doesn't stop?
If it stops,
is that your question?
So we're looking at the Suska station near the border. If this is disrupted, what happens to the price of gas?
So I think, look, of course it's going to go up, but again, we have so much storage for Europe right now. And remember, we've lost about 15% of industrial production for good in Europe, both industrial and residential as well, some through efficiency gains, some through just losing industry to the US because of IRA there, and just generally very high gas prices. That's how Europe has balanced. So demand just isn't that high right now, and that's why the amount of gas we have in storage has been enough, and that's why prices haven't gone up as much. Yes, there is some upside risk, but that's why I'm saying I don't think the risk is nearly as much as what we had in the past, like 2022, just because demand is outright lower.
So interesting. Amrita, thank you so much for joining us. Amrita Sender, founder and director of research at Energy Aspects. Now to some other stories making news, and Disney has reported mixed third-quarter results with weakness at its theme parks offsetting its first-ever profit in streaming. Now Disney sees pressure on park attendance lingering for the next few quarters after previously predicting a rebound in the final months of 2024. And Warner Brothers Discovery shares tumbled in late trading after second-quarter results that missed expectations. The parent of CNN posted a charge of $9.1 billion after writing down the value of its traditional TV networks. Now, the firm has concluded that cable channels are no longer worth what they were in 2022 when Discovery acquired Warner Media. Cathie Wood has scooped up shares of tech firms caught in Monday's market rout, just as her flagship fund actually sank to a new low for the year. Now, Wood's ARK Innovation ETF bought Amazon, chip maker AMD, and streaming device maker Roku, amongst others, while ARK closed Wednesday at the lowest levels since November, down more than 20% this year. Now, a couple of the things that we're watching out for: Siemens shares also struggling for direction after a weak second quarter for the German industrial firm's factory automation business was balanced by a jump in software demand. I'm also looking at Zurich Insurance posting a 7% gain in profit for the first half of the year that actually beat estimates as it increased revenue from its life segment business, while Munich Re is actually reporting net income for the second quarter that beat estimates. Now, coming up, shares rallying in the FTSE insurance firm Beazley after a profit beat. So we discuss everything from climate risk to cybersecurity with the company's chief executive, Adrian Cox. That's coming up next, and this is Bloomberg.
Do you think it'll be the case where someday you will be an investment committee or I'll be an investment committee and we just apply AI, decide whether it's a good deal or not, or we're not going to be there anytime soon?
I don't think we'll be there in the near term. And David, because being on investment committees, there's the analytics of the math, there's the people, and then there's judgment. So analytics and math, I think AI will help us get way more refined. Right now, we have analysts building models upon models. Our typical investment memo is 86 pages. So we could refine that down very, very seamlessly to pieces. The people aspect to it, to make a judgment call on, do I believe this entrepreneur is going to go the next mile? Do I believe that the background of the entrepreneur, who they are, what they stand for, their values, their family, that's the harder one. I think AI is going to take some time to get there. And then the final piece ends up being judgment. And I don't believe we've seen anything yet that gives us a sense of judgment that we're able to apply.
Bloomberg has enhanced search on the terminal to deliver what you need when you need it. Now, you can simply type phrases in everyday English in the command line. Compare financials. Find people. Analyze markets. You can enter phrases or ask questions. What do you want to know today? Ask a question or visit SearchGo to find answers now.
DOJ or other authorities.
Could face bigger challenges.
Britain's next. It was going to keep reading World Cup. This is a 3
as the economic picture
covering the intersections of Hollywood, Silicon Valley, and beyond.
Well, good morning, everyone, and welcome to The Pulse. I'm Francine Lacqua here in London, and these are your top stories. European stocks slip as volatility grips global markets. Weak demand for treasuries weigh on sentiment in the U.S. Well, JP Morgan says there's an increased chance of a U.S. recession this year, this as it estimates 3/4 of the global carry trade has now unwound. And in the UK, anti-racism protesters turn out in their thousands to counter far-right demonstrations that failed to materialize as Britain probes possible foreign government involvement inciting violence online. Well, shares in Lloyd's of London insurance company Beazley are rallying this morning after it reported pre-tax profit for the first half of the year well ahead of estimates. Now, the FTSE 100 firm is navigating a series of threats, including climate change, geopolitics, and cyber risk following the high-profile outages at Microsoft and CrowdStrike. So let's discuss all of this with Adrian Cox, the Chief Executive of Beazley. Adrian, welcome to The Pulse. Thank you so much for joining us. So you have a strong set of results. There's just a lot going on in your industry between, catastrophe-related claims, between what's happening with cybersecurity. What do you worry about the most in the next 12 months?
I think we're living in an era of accelerated risk and an elevated risk, and there are lots of things to think about. In contrast with a few years ago, the performance that we've managed to generate this half year is against the backdrop of there's a lot of stuff going on, and we have to worry about it all. I think the CrowdStrike outage was very interesting. And people have been waiting for a while for such a thing to manifest, to see what it would look like, and it has. And I think fortunately, businesses recovered fairly quickly, and insurers did their job. So I think the answer is lots of things rather than just the one.
What can you learn from what happened with Microsoft and CrowdStrike?
I think it's a very interesting data point. On the one hand, you can see the impact that an error in one company can have across the world. I think on the other hand, you can see how quickly that impact can be mitigated. The error was identified fast. The fix was put out relatively quickly, and most companies got back after a day or two. So I think it shows the potential, but also the potential to fix things quite quickly, and that's quite useful. I think had it been a cyber attack, it would have been a much bigger issue.
Can you talk us, when you look at some of the projections for catastrophe-related claims in the second half of the year and into next year, is an increase a new norm?
Yes, I think we've been seeing an increase in the level of catastrophe activity for a number of years now, and not just the sort of traditional catastrophes of hurricanes and earthquakes, but also other things like severe convective storms, flooding, wildfires, and so on and so forth. And I do think we can expect to see a continued incidence of them in both where you expect them and also in new areas. And that's something that we have to figure out and cope with and price and build resilience for.
Yeah, so how do you do that? Again, are you setting aside provisions for the increase in some of these claims? Do you have to do new products? What does it look like 2-3 years from now?
Yeah, so I think when you're looking at natural catastrophe risk, you have to have a forward-looking view of risk, because things aren't behaving as they used to, and you need to think about that. But I think, and so yes, we need to provision for it and to price for it, but ultimately I think it's a case of building more resilience against it. So thinking about how you build and protect assets, so that despite this increased incidence of natural catastrophe activity, assets remain intact. That's the ultimate answer.
How do cyber attacks change your business? Do you need to rely a lot more on consultants and advisors to try and understand the threats out there?
Yeah, so we work with a lot of companies and governments around the world to monitor and figure out how to mitigate new threats. We've also got quite a big ecosystem in-house that kind of allows us to do that. Underwriting cyber is a live thing. New threats emerge constantly. But I think, it really shows the value of insurance, because we can understand this stuff.
we can help our clients understand this stuff and protect against it. And it's a key risk for businesses.
But is it going to get harder with AI? Again, I know there's like worst case scenario, there's best case scenario. I mean, some of this stuff, frankly, is like nightmarish. How quickly do some of these threats get worse?
I think these threats change all the time. AI is both an opportunity and a risk. It's an offense and it's a defensive tool. And actually, we're finding it is as useful for defense as it is for offense at the moment. I think AI has helped some attacks get more automated and more scalable, but we can figure out how to protect against that. And so, as with all things technology, it can be used, for good and for crime. And it's just another thing that we have to think about.
Are you also rolling out more catastrophe bonds, I guess, tied to cyber?
Yeah, so we launched 2 this year. I think it's an extremely useful tool for us. We will consider continue to work with the ILS markets to do more of that. I think as cyber demand grows and therefore the amount of business we write grows, we have to figure out how to hedge it properly. And the catastrophe bonds are a useful way to do that. And there's lots of investor appetite to do it. The ILS industry traditionally has been concentrated on natural catastrophe risk, and cyber diversifies against that. So it's a useful new investment for those capital markets to do.
And so that's, I mean, how much more? Is it difficult to quantify with these rising premiums of how much of this type of product you will offer?
I think there's, so the ILS market for cyber is several $100 million now. It's a fraction of the size of the natural catastrophe ILS market, but I think it has the potential to be the same size. So, we're sponsoring bonds. Other insurance companies are doing the same thing, and I think it's a market that should grow quite quickly, and that's very exciting.
I know that our viewers just want to know more about what kind of threats they're faced with. How much of do you have a breakdown of how many of these cyber threats come from state actors? And how much are they from actually, people doing it for business?
The vast majority of cyber attacks are for criminal purposes, i.e. for making money.
Yeah.
And that accounts for the vast majority of what we see. I think the really big potential events are more driven by nation states because they're the ones with the capability and the resources to be able to do that. And those are the ones that are more politically motivated. I think the consequences of a nation state doing such a thing are quite big, and therefore they're relatively rare.
And we talk a lot about, again, AI being able to replicate voices and things like that. Is there a use for AI in trying to protect against cyber attacks?
Absolutely.
What does that look like? Absolutely.
And, we're seeing government agencies and others start to do that. As I say, I think they're actually more useful for defense at the moment, and that's a good thing.
Adrian, thank you so much for joining us. What a fascinating conversation.
Thank you.
It's a complex world out there.
Yes, it is.
Yes, it is. Adrian
Cox,
Coxler, Chief Executive of Beazley. Coming up, anti-racism protesters turn out in their thousands to counter far-right gatherings that failed to materialize. The latest on the UK unrest is next, and this is Bloomberg.
Welcome to the world of decentralized finance.
With the surge in Bitcoin, you have crypto stocks also surging.
Bloomberg's covering all things crypto, the people.
This is a political attack, and we must hold our elected officials accountable.
The transactions.
Really a record-breaking moment.
Bitcoin is the exit strategy.
And the technology.
Awareness is going to grow, and these things grow the overall industry.
Crypto as an asset class is here to stay.
Bloomberg Crypto, only on Bloomberg. Bloomberg covers the world with unmatched reach and resources. From more than 120 countries, the moment news breaks, 24 hours a day, Bloomberg. Context changes everything. A lot's happening on Wall Street.
I couldn't have been more wrong.
It's going to stay volatile for a while longer.
It's a bifurcated market.
Need to catch up?
This is Bloomberg Wall Street Week. I'm David Weston.
We've got the information and insights.
Year over year, you could start to see some cracks.
It might be overhyped short term, but it's underhyped long term.
From businesses most influential and instrumental.
A lot of the doom and gloom has been somewhat overblown.
If you're not living near the edge, you're taking up too much space.
Bloomberg Wall Street Week, only on Bloomberg TV and radio. Context changes everything.
Well, let's turn our attention to the U.S. election now, where Vice President Kamala Harris and her new running mate, Tim Walz, continued their tour of key battleground states. Yesterday, they held rallies in Eau Claire, Wisconsin, and Detroit as they looked to turn on the charm to voters in swing states. Well, let's speak to Bloomberg's Bill Ferries. He's been covering this very closely. Bill, thank you for joining us. So how are the Democrats organizing themselves, and how are they doing in the polls?
Well, the Democrats' big goal right now is to really get Tim Walz out there, help define him, try to keep this momentum going from Kamala Harris's first really 10 days as the candidate for the Democrats, heading into the Democratic convention, which is the week after next. But you know, Walz just announced as a vice presidential candidate, and so they're hitting the road trying to campaign in those critical battleground states. We've seen them in Wisconsin and Michigan, as you mentioned. They're going to continue on to places like Nevada and Arizona in the coming days, really trying to get in front of the voters who are going to decide this election.
So how's the Trump campaign actually fighting back, and where do they go next?
Well, it's interesting. What we saw over the last day or so was the Vance campaign kind of trading places with the Harris-Walz campaign. J.D. Vance was in both Michigan and Wisconsin, just like Kamala Harris and her running mate were. We have not seen Donald Trump on the road this week. He will make an appearance Friday in Montana, which is a very Republican state. It's surprised some people that he hasn't been out there a little bit more, punching back directly in front of his supporters, but that may still come in the days ahead. They are really trying to also define Tim Walz as someone who is too progressive for America, who doesn't share the values of who they think the majority are. So far, the momentum seems to be on Harris's side. She has wiped out the lead that Donald Trump had in most polls before she became the nominee, and has obviously closed the money gap, as we've been reporting over the past week. There's still about, I think, 89 days to go now before the election, so I think there will be ups and downs from both campaigns in the weeks and months ahead.
Bill, thank you so much. Bill Ferries, of course, almost on the campaign trail for us, and we'll have plenty more throughout the day. We have a video also of J.D. Vance, well, very close to Air Force Two, and we talk merchandise. Now, thousands of anti-racism protesters rallied across the UK last night following more than a week of rioting by far-right groups. Now, misinformation on social media helped to fuel the days of unrest. Elon Musk was criticized after suggesting on X that the riots were due to mass migration, adding that, quote, civil war was inevitable. Let's bring in Rosalind Matheson, our EMEA news director, and also Parmi Olsen, our Bloomberg opinion columnist, who specifically has been talking about the riots and text. So thank you both for joining us. Roz, I mean, yesterday there was a lot of police, out there across the UK getting ready for more far-right protesters. That didn't materialize. We actually had the opposite. It was anti-racism protesters that were out in force.
Well, that's right. So we're all prepared for these far-right groups to gather in these different sites around the country, mostly outside London. We knew there was going to be a big police presence there. They were warned about that. But in fact, the numbers that turned out were the counter-protesters, the anti-racism protesters, really fanning out to these places in numbers, ready in case these people turned out. And they didn't in the end. There were a few scattered gatherings. There was a bit of scuffling that went on. Some arrests were made, but nothing like the level of the riots and the violence that we saw over the past week. And, a clear message was sent to them from the government, from the police, that they are going to face arrest, they are going to face court and possibly jail, and that's going to be done very, very quickly. So quite a strong message there. The question is, they didn't come out last night, but are they gone?
Yeah, and Parmi, I guess the other question is, of course, who do we know? This is based on misinformation. This is not something that's happened in the past in protest, actually against the cost of living or some, a policy on immigration. Who do we know is behind some of this misinformation?
Well, it's been traced back to a news story on a site called Channel 3 Now, very soon after the Southport attack. This news site named the attacker as a Muslim asylum seeker. That could have been the end of the story. The problem is that people shared that story on X. They shared screenshots of it, and it went completely viral on X. Since X, formerly known as Twitter, was bought by Elon Musk, the trust and safety team of that platform has been gutted. Much lighter content moderation on misinformation. And so that's why this story was just allowed to spread. And you had online influencers like Andrew Tate, went on to tell his more than 9 million followers that the attacker was an illegal immigrant. That ended up being picked up by Nigel Farage, who was saying similar things in TV interviews and kind of making similar suggestions. He later said that he got that information from people like Andrew Tate on Twitter. So it's actually had a massive impact, the spread of this misinformation on social media, and X in particular. And then separately on another platform called Telegram, it's a messaging and broadcasting app. That's where you saw not only misinformation, but also calls to violence. I saw some posts that said, Wednesday night, mask up, no more immigration. They won't stop coming till you tell them. This is in a channel of 13,000 people. That was meant to be for last night, for Wednesday night, which didn't happen, of course, because the anti-racist protesters came up much more in force. But previous to that, over the past week, I don't think people were really aware that these kind of calls to violence were spreading around platforms like Telegram and to some extent TikTok as well.
Rosa, is this also, we're 1 month into the new government under Keir Starmer. Immigration wasn't really part of his platform, immigration policy. So is this also to test the new government or to send a clear message?
Well, quite possibly it's a bit of everything. So we do have that new administration after the Tories were in power for a long time. Perhaps these groups want to cause a bit of mischief for Keir Starmer and his new administration. It's a big challenge for him because he came in saying, I want to focus on the economy, we've got a budget, we're going to have policy. Instead, he's dealing with some really fundamental questions for British society. And so there's that aspect of it. But, also it's just riffing off the horrible events of Southport, that disinformation and fanning thing that we've seen go on. And that's really something you can trace back to years of conversation and debate and tension in the UK over migration, related to the Brexit decision and so on. It's never really gone away. And even if these riots do stop again, fundamentally, you still have these issues where people feel quite strongly about migration. A lot of people feel that it's being dragged into a poisonous debate around race, religion, and so on. And so how do you deal with that? And that's the broader question for Keir Starmer also.
Yeah, and how do, some of the platforms address it? And one of the questions that we've been trying to figure out is actually, if Elon Musk tweets something on X that says the UK on the rest of civil war, is there anyone to stop him saying that?
Well, exactly. And I think to your question about the platforms, it's very different how they deal with this sort of thing. I think Google actually does a pretty good job with kind of keeping an eye on the spread of misinformation on YouTube. X does not. And part of the problem, I think, for Keir Starmer as well is he's inherited a law that was put together by the Conservatives, which was actually very ambitious in its scope to address online safety and, in particular, calls to violence and misinformation. The problem was, just before it passed, a key part of the law that addressed legal but harmful material, which would have encompassed misinformation like we've seen over the past week, got taken out. And so now regulators here like Ofcom cannot go to the likes of X and say, you've broken rules, because actually they haven't broken rules. There are no rules about misinformation. They were very cleverly designed for this act to try and thread the needle of free speech. They were based on health and safety law, but unfortunately that got watered down. So I think Keir Starmer is in a very tricky position now, because he had this law that he could the Ofcom could use to address these issues. That's been watered down. And now he's dealing with Elon Musk, who's effectively an internet troll. The saying goes, don't feed the troll. And so Starmer has to also make sure he doesn't get drawn into a war of words with this billionaire who has been fanning the flames on his own platform and just causing a lot of trouble.
And Roz, then, of course, in Austria, so Taylor Swift has canceled 3 concerts in Vienna after authorities there said they had uncovered an Islamist terror plot to attack some of the fans in the city. What does that, I mean, this is a threat that's coming back.
Well, that's right. So what we know is that they've arrested 2 people, including a 19-year-old. They say that the 19-year-old seems to have been radicalized by ISIS. We don't know a lot about that. There are reports that perhaps a 3rd person has been arrested. They seem to have been considering a bunch of potential targets in Vienna, including the Taylor Swift concerts, which have now been cancelled. We don't have a lot of detail about how advanced those plans were these 3 acting as a small group. We don't have a lot of detail, but it does come into that environment again, like Austria also, like many countries in Europe, is facing those conversations around immigration, race and religion, and struggling with them. And how do you deal with the fact we've got a lot of migration coming from different parts of the world into Europe, people who are fleeing desperate circumstances, but that creates, debates and conversations in the countries they come to. And, again, disinformation may have played a role in what we've seen in Austria, but we are expecting more details about that, potentially from a briefing with the prosecutors in Vienna in a couple of hours.
Ross, thank you so much. Rosalind Matheson, Bloomberg's EMEA News Director. And thank you also, Parmi Olsen, Bloomberg opinion columnist. Now, coming up, weapons and ammunition manufacturer Rheinmetall beats first-half sales estimates. We discuss what that tells us about Europe's defense sector. That's next, and this is Bloomberg.
From our studios in New York and San Francisco, our expert hosts have the data and analysis about the companies you know and the startups to watch, plus the interviews you don't want to miss. Watch Caroline Hyde and Ed Ludlow on Bloomberg Technology, the only daily business show dedicated to tech, right in the middle of the trading action, every weekday, only on Bloomberg Television. Context changes everything.
Access the financial world on demand. Hear from leading economists, policymakers, and industry experts via live and on-demand webinars, only from Bloomberg. Start exploring to see what's moving the markets. Visit Bloomberg.com/webinars.
Well, German defense manufacturer Rheinmetall has beat estimates for the first half of the year, reporting better than expected weapons and ammunition sales. Let's get more with Bloomberg's Laura Alves, who's in Frankfurt. Laura, good morning. So how did Rheinmetall fare in the second quarter, and what does it actually tell us about defense in Europe?
So Rheinmetall had another very exceptional quarter in this second quarter. What is happening to them, the CEO has described as an accelerating super cycle. He says that they've never seen that kind of growth before. The company's profits doubled. They increased sales by half. So this really tells us that the European defense ramp-up is very much still ongoing. And the company is also seeing sales of around 10 billion euros this year, which is very much unheard of for a German defense contractor so far. And in addition to that, with Rheinmetall, all eyes are on backlog as well, where they currently have over 48 billion euros in backlog, which is another new record that they set. And this is set to increase to 60 to 70 billion euros. So you can really see that there is no shortage in orders or interest in the European defense space at the moment.
So, Laura, one of the craziest stories was, of course, the assassination plot against the company's CEO. What does it tell us about them being targets?
So basically, with this assassination plot, it was a Russian plot, and the US and German security forces uncovered this and foiled the plot. And this really shows that not only are individual companies, but also individual people, in this case, very much in focus in a way that is unprecedented. This plot involved other defense chiefs as well, not just Pappberger, but he was a target that was, his plot was the most mature one out of all of them. And this really shows us that this is another facet of this hybrid warfare that Russia is waging at the moment with cyber attacks, espionage, and so on and so forth. So the situation is being closely monitored at all times, obviously, but it definitely remains tense.
Laura, thanks so much. Laura Alves there with the very latest on Rheinmetall. Now, this is a picture for European stocks dropping. We've had a week. It's been a week and a half, but it's only actually been 4 trading days. So European stocks are dropping, prolonging this volatility that has really gripped global markets, I would say, over the last 4 days. Again, this is as the debate around central bank policy decisions continue to fuel this investor anxiety. Today, we have U.S. jobless claim figures. They're definitely in sharper focus than ever after last week's flimsy payroll numbers, and then investors also bracing for U.S. and Japanese central banks to potentially move interest rates in opposite direction in the coming months. Up next, a Bloomberg Brief with Manus Cranny in New York, and this is Bloomberg.
Let's suppose you're on a plane and somebody realizes who you are. They say, I have $100,000. I don't know what to do with it. Where should I invest it? Where should they put their money?
So today, it's a easier decision than it was maybe 2 years ago because Treasury bills are 5%. So I would say, regardless of how much risk you want to take, you have to put a portion there. Then you would have to ask, really, an individual is the same, I think, as any institution. What is your time frame? Do you need to get access to this $100,000 in the next few weeks, the next few months, the next few years, not until you retire. And that will determine your investment decision.
So what do you think is the most common mistake investors make when they have 100,000, $1 million, or whatever they might have? What is the most common mistake you have observed that investors make?
I would say hubris and thinking you know more than you do, because every decision that you make has many, many layers. So as you're creating a portfolio, look at the risk as well, not just excited about the return.
And what's the best investment advice anybody's ever given to you?
Continue to learn about innovation in whatever you do, because that is where it's not exciting, that's where returns will go.
Could face bigger challenges next.
It was going to keep reading World Cup. This is a 3
as the economic picture,
covering the intersections of Hollywood, Silicon Valley, and beyond.
Good morning from our global headquarters in New York. I'm Manny Scranny. You're welcome to Bloomberg Brief. Let's get setting that agenda. Stocks stumble, lowered by mega tech as JP Morgan assesses the unwind of the carry trade is now 75% complete. Focus turns to the jobless claims. It's a media blitz as Warner Brothers takes a $9 billion write-down on its TV networks. And Disney feels the pinch of the consumer in the parks division. Vice President Harris and Governor Tim Walz pick up momentum in the Midwest as they visit Michigan and Wisconsin to sell voters their message. This is J.D. Vance, mirrors the schedule. A very good morning. They say often that the road to recovery hell is paved with good intentions, and that is the problem with the equity market. The Bank of Japan gave you the cover yesterday, but what is the quality of that cover for the carry trade? We understand from JP Morgan 75% of it is already done. Perhaps the narrative is the stumbling of the bond auction yesterday, which sort of unseated risk a little bit. What I can tell you is the focus squarely on the 240,000 jobless claims today. The market thinks we could move by over 1% either way. A couple of stocks to keep an eye on. The Nasdaq is eking out the tiniest of gains. Cathie Wood is in there buying the dip. ARK Investment Management picks up some Amazon, some Meta, some Roku, some other stocks just to keep an eye on. Warner Brothers taking that $9 billion hit on the TV networks. CNN and TNT just not worth what they were when they did that over $40 billion deal a couple of years ago. Disney, the parks, consumers are not delivering at the level. Of course, this is the bulwark of Disney. They may be adding to the streaming numbers, but the parks are underwhelming. The bond market, as I say, 391 is where you are. The market shunned that 10-year offer yesterday. The bid-to-cover ratio was lower at 232 relative to the recent bid-to-cover ratios of 2.53. Let's see whether we choke on $30 billion worth, on $25 billion worth of 30-year paper today. By the way, JP Morgan moved the risk of a recession up from 25% to 30%, and dollar yen turns it around ever so slightly. We are off a higher level of yen that we had yesterday. And again, the question is how much of this carry trade has been covered in the spot market, and are we moving to the second leg lower of that? That is the question. Here's what some of our guests have been saying about markets, the outlook, and the odds of a recession.
So Nikkei and S&P 500, reasonable, notwithstanding the hedge funds and the volatility got what they wanted, and by no means is it behind us, but the severity and the degree of it we believe is behind us.
We're still in the soft landing camp. Our point is, look, markets got spooked by the payroll last week. They got spooked by the ISM manufacturing data, but the economy is not that bad.
The market sentiment swinging to a recession with the SAM rule, etc., getting triggered. I'm still not in that camp because I think there are enough resilient factors in the US economy.
Even if we have a downturn, it's going to be a fairly shallow downturn.
So it's sort of a mixed bag because I think the policy reaction function does differ across Asia and not everyone is just following the Fed.
Context is everything. How shallow will this dip be and have the hedge funds really got what they wanted? My guest this morning is Ian Steely, International CIO of Fixed Income at JP Morgan Asset Management. Ian, timely to have you with me. Let's just talk about the choreography of what we've had. A job shock, a growth scare, a carry trade unwind, a vol shock and a VAR shock. I have not seen bond markets this hysterical since 1994. Has that hysteria passed?
It does feel that we're getting a sense of calm at the moment. And as you said, there was just a combination of events that occurred over the back end of last week and then obviously starting Monday in Asia, in the Asia session, which led us to this volatility environment. But I think that we've seen some calming messages from the Bank of Japan. I think that we have heard sort of a more calming measure from Fed officials that let's not panic on this. And it does feel, as you said earlier on the segment, that a lot of the carry trade has been unwound. And actually that puts us in a better environment. And now we're in a place where we need to make a decision as to whether that jobs data report from Friday was correct. And we are seeing a slowdown in the US economy or into a recession, or actually maybe it wasn't as bad as first perceptions when we get the revisions through and when we get some of the weather adjustments and things look a little bit more bright and we're on a sort of the sub-trend recovery that we've had for the last few months. And I think the jobs report, the initial jobless claims report today is going to be very eagerly watched by a lot of market participants.
Yeah, and we're looking for 240,000 on the jobless claims. It will be a razor focus. Yesterday, I would say it wasn't the classic Fed put. It was the Bank of Japan. There's no irony here. It was the Bank of Japan verbal put option. But what we need to debate now is what is it that the Fed needs to deliver as it were, a soft landing. At one stage, we were talking about 5.5 cuts, a 40% probability of 5.5 cuts. Now, that has been scaled back dramatically. In your view, when you look at the backup in yields in 2s and in 10s, Ian, what's the bond market telling you now? Is it steady as she goes 3 cuts into December? Or what is it could really push them to a 50 basis point, pulling the trigger on 50 basis points?
So I think if you're the Fed, and remember the Fed took their dot plots down from 3 to 1 back in June, I think they're going to want to show that they're not panicking, and they're going to want to show that they ultimately are making a decision, not just on one data point, but on the entirety of the data, which is what we've heard from them. Now, that's not to say they can't go 50 basis points in September, and I do think it's going to be very critical when we get the August jobs report to see whether we have seen any improvement from what we saw last Friday. And if we don't get an improvement, then by all means, they should be looking at moving 50 basis points. But if they do get an improvement and they may say, actually, we're ready, we're prepared to work, we're prepared to ease policy from a very tight level, but actually the data is just trending down, they might be more tempted to look at 25. So I think it's going to be very key, that jobs report at the beginning of September. Obviously, this time is going to work in their favor. They are going to get that jobs report before the September meeting, unlike last week.
And this is the debate that I'm having with a number of people on the IB. In 2007, they did 50, 25, and 25. In 2001, which is the nearest reference point of where the market could expect something much more significant. So this is not 2007. This is not 2000. This is, by all accounts, if you take the Atlanta Fed GDP now, third quarter real GDP at 2.9%, this is about a slippage in jobs, and that's what JP Morgan, the parent for you, say. It's about job shedding, and it's a question about the velocity of that job shedding and whether that really accelerates, isn't it?
I think you're absolutely spot on there, and I think actually when you look at the jobs report, has that unemployment rate gone up because of people entering the labour market? That seems to be what we're seeing from the data. It's not coming out because jobs are being shed at the moment, particularly permanent jobs. And when we also, as you said, Atlanta Fed is showing 2.9%, and that's actually ticked up since the data last week, based on what we've seen this week. And then actually when you go through company earnings, we're not talking about layoffs, where they're not giving us profit warnings. They're not saying that they're seeing a real downturn. They're keeping revenue and earnings forecasts in line at the moment. So again, you're completely right. This isn't 07. This isn't the tech blow up. And that was why very early this week it did seem a bit as if the market was overreacting when we were talking about intermeeting cuts.
That's why I thought it was very stoic of David Solomon to say this is not a sort of a major eruption. If you have a look at the VIX, it might be something different. And if you were in that bond market, it was a touch of hold on to your seat. Here we are. We've had a pretty solid bounce, haven't we? Twos have bounced by 30 ticks. We've gone from, what, 265 up 30 ticks in the space of 4 days. Tens have bounced by 27 basis points. The market convulsed yesterday on the auction. Can you put a bit of color on that for me? Because it's an interesting, they had to cheapen it quite a bit. So what was the reticence? Because we've got 30s coming down the pike today. What was that jolt?
So I think it wasn't just the fact we had the Treasury auction. We had a lot of investment-grade credit supply as well, and that actually got taken down very well. I still think there is a demand for high-quality fixed income. I just think there's some people out there thinking sub 4%, is that really where we want to be going into these auctions at, particularly when we've got the 30-year coming up in the next 24 hours. So I do feel that there is a strategic desire for people to own duration. I think there's been a lot of duration bought over the last few days. I just think maybe people are getting a little bit concerned. Do we see a little bit of a pullback if we do get a better jobless claims print today? If we do get better jobs data over in the next print, maybe we should be thinking more 25 rather than 50, and actually yield should be a little bit higher. That's not to say we're going back to some of the levels that we saw just a few weeks ago, and I do think the strategic direction is for lower yields, but maybe they're just calling into question how quickly that can happen.
Yeah, as you say, the risk reward is still about owning bonds. But those steepeners perhaps have narrowed a little bit. Ian, thank you very much. Context this morning as we go into the jobless claims numbers. Pretty important Thursday in studio there of JP Morgan Asset Management. Other stories trending on your Bloomberg terminal this Thursday morning. Jamie Dimon says he's skeptical that inflation will return to the Fed's 2% target. The JP Morgan CEO cited risks including deficit spending and the ongoing remilitarization of the world. He expects the Fed to lower borrowing costs soon. Cathy Wood scooped up shares, as I was saying, in tech firms, caught up in Monday's market right. The ARC CEO bought Amazon, AMD, and Roku, among others, at the start of the week. Her flagship fund is down more than 20% this year. 3 Taylor Swift shows planned for this week in Vienna have been cancelled due to terrorism threats. Austrian police arrested 2 people on suspicion of planning a terror attack. Swift was scheduled to have 3 shows in Vienna, all part of the Eras tour. Now, in the middle of all of this equity madness, I show you what's happening with Dr. Copper. Declined by 20% from its peak on May the 20th. You've got stockpiles aplenty in London, rising the most in 4 years on Monday. But look, the Bloomberg Commodity Index also at a 6-month low. And you're looking at iron ore. Let's have a look across the board. Iron ore is down 27%. The issues are this. You've had a growth scare globally. China is still under pressure. Copper bouncing back into the green. It dropped by $159 yesterday. So do not be beguiled by 1/4% of a rally. So the growth scares are real in the metals and commodity markets. Coming up in the show, Warner Brothers Discovery posts a multi-billion-dollar charge on the value of their TV networks. We look at how that media landscape is changing. And later this hour, we'll catch up with RBC's Laurie Calvasina on whether the U.S. is tipping into a recession. Context matters every day on Bloomberg.
Welcome to the world of decentralized finance.
With a surge in Bitcoin, you have crypto stocks also surging.
Bloomberg's covering all things crypto, the people.
This is a political attack, and we must hold our elected officials accountable.
The transactions.
Really a record-breaking moment.
Bitcoin is the exit strategy.
And the technology.
Awareness is going to grow, and these things grow the overall industry.
Crypto as an asset class is here to stay.
Bloomberg covers the world with unmatched reach and resources. From more than 120 countries, the moment news breaks, 24 hours a day. Bloomberg, context changes everything. Get your fixed income fix. Watch Bloomberg Real Yield every Friday right here on Bloomberg. Context changes everything.
From the beating heart of global finance, economics, and politics, and wherever newsmakers are moving markets, Bloomberg brings you conversations that allow for deep discussions and important insights. What do you think the future is for inflation? Is this a new normal? Are markets too optimistic? How do you worry about the things that are outside your control? How does the current fighting completely stop? I'm Francine Lacroix, and this is The Pulse, every weekday only on Bloomberg.
It is Bloomberg Brief. I'm Manish Krenny in New York. Warner Brothers Discovery say that the cable channels, CNN, TNT, they're no longer worth what they used to be. Shares tumbled as the media giant posted weak results. It wrote down the value of those TV networks, taking a $9 billion charge. Tom McKenzie is with me. Tom, when you look across this report, yes, streaming, they're building it up, but these traditional legacy assets that they bought in the deal, they're just not up to par, are they?
And they take a charge on the back of that, Manus. That's the charge it comes through. It's an eye-watering number, quite frankly, $9.1 billion. That deal, of course, was cemented in 2022 between, of course, Discovery acquiring Warner Media. But what they're saying, absolutely, to your point, that their legacy businesses, the legacy TV parts of that business, so CNN and TNT, are just not worth what they once were when they pushed through that merger, worth $42 billion at the time. So they take this charge, $9.1 billion. The Q2 revenues, by the way, falling 6% for Warner Brothers. If you're looking for a bright spot, for a silver lining for this business, then look at the subs, look at the streaming part of the business, because they did manage to increase the numbers by 3.6 million in terms of the subs. That was above the estimates, and they now have a total number in terms of subscribers for that streaming part of the business of more than 103 million. Ad revenues as well for that part of the business also coming in higher than the estimates. But yes, they're taking this charge, and it's a reminder of the squeeze on ads and the cord cutting that continues.
And the CEO, David Zaslav, basically saying, look, everything's on the table. I know there have been stories around splitting the digital assets away from the studio and one thing and another, but it does sound as if a debt pile of nearly $40 billion and a cash flow that's under pressure may well mean all options are still on the table. I just want to focus in on Disney, because they posted their first ever profit in streaming, but signaled that there's weakness in the famed theme parks. Now, the company's CFO caught up with Bloomberg after posting the results.
The lower income consumers are a little bit stressed and shaving a little bit off of their time at the park. And then higher income consumers are tending to travel overseas a little bit more right now. So we really just see this as a few quarters of slight perturbation in the numbers. Frankly, I think we're going to be right back as we get into the middle of next year.
Now, I've never been to a Disney theme park. I don't know whether you have or not, but people tell me that it is ridiculously expensive at the moment, really expensive. So, you know, this has been the power horse, this ballast within Disney to the streaming business when they were having a tough time. So has the cadence, has the balance changed within the Disney family?
Look, Manus, I was there in April, and I can attest to the cost of going to Disney, and I was there taking the kids. Look, yeah, it's expensive. They're challenged in terms of the costs. So the input costs are there in terms of wages and having to maintain the facilities. Look, this is still the part of the business that makes up 2/3 of Disney's revenues. And so when they talk about the squeeze that some of their consumers are under at the lower end, and this is how they characterized it, those people are spending less time in the parks and spending less money in the parks. And then at the high end, those with more cash to spend are just not going to the parks. They're traveling overseas to get their entertainment there. Things like the Olympics was a factor. They also talked about the relative softness, by the way, when it comes to the parks in the Chinese business as well. And they've got that park just outside of Shanghai. So this is what led to the concerns around the outlook for Disney, even as, of course, on the earnings front, this was a beat in terms of earnings and revenues, and they raised their guidance. But it's concerns about the parks. Look, again, if you're looking for silver linings with Disney, They came through the first profit in about 2 years for films, and then the subscription part of the business, the streaming part of the business, coming through with a profit for the first time, of course, of about 40 million, and ahead of those targets.
Well, of course, the CEO, they're taking sort of remedial action. 2,000 jobs went last year, and 100 jobs went at CNN last month. Tom, thank you very much, tracking the Disney trail. Coming up in the show, we're going to take a look at the other headlines around the world, including the surprisingly peaceful protests that took place across the UK. Instead of the riots that the police had feared and scheduled in anticipation for.
We invest in, buy, and own the backbone of the global economy. When the water gets delivered to your house, the road you drive on, the pipeline that brings different things to your community, the telecom towers that transmit your phone, the data center, the real estate that you live in. It's what we own and build, so it's really what drives the economy, and you don't often see our name.
Is that a good or a bad thing?
You know, it's just because we're behind the scenes, but it's big, with $1 trillion of assets almost. We're behind a lot of the things of the global economy.
So being low-key, do you think it gives you strength?
We just try to be quiet and do our thing, and sometimes it helps and sometimes it doesn't. But I'd say on balance, it's been good for us.
From our studios in New York and San Francisco, our expert hosts have the data and analysis about the companies you know and the startups to watch, plus the interviews you don't want to miss. Watch Caroline Hyde and Ed Ludlow on Bloomberg Technology, the only daily business show dedicated to tech, right in the middle of the trading action, every weekday, only on Bloomberg Television. Context changes everything.
Front page news from around the world. These are some of the headlines on the other sites. We've got the BBC. The UK's Metropolitan Police Chief celebrates, quote, a successful night after England sees mostly peaceful rallies. The country was bracing for further far-right riots after violence on the weekend, and that has been the dominant theme throughout the week in the United Kingdom. Next up, Financial Times, Google and Meta struck a secret deal to target ads for Instagram teenagers on YouTube. Now, the deal skirts Google's own rules on how minors should be treated online. Documents seen by the FT suggest steps were taken to disguise the true intent of the campaign. That story will certainly get some pretty sharp attention. And on Bloomberg, Iran calls on Israel to agree to a truce on Gaza. The Iranian president told his French counterpart that the US and Europe must urge Israel to accept a truce to reduce tensions in the Middle East. Well, let's pursue that conversation. Dan Williams joins me now from our Jerusalem office. Dan, thank you very much for joining us. So these diplomatic efforts coming from France, obviously the fulcrum of most of the political efforts have been hosted by Qatar. So what role and what heft does France have in these negotiations with the US and the others involved?
Well, first of all, France has open channels to a number of powers in the Middle East, including Israel, including, as you just noted, Iran, which would not directly communicate with Israel given several decades of open hostility existing between the countries. France also has inroads for historical reasons in Lebanon, which we would expect to be one of the ground zeros of a major flare-up of these regional tensions, should that occur. So using those ties in Iran, in Lebanon, France is one of the countries trying to weigh in, trying to intervene, trying to head off what would appear to be escalation that would take more than 10 months of fighting in a more serious direction.
It has, and the communication from this side of the pond, from Vice President or on the ticket, Kamala Harris, along with Biden, is they really are pushing towards the cause to end this conflict. What is the latest out of Israel on whether a ceasefire might be achieved?
I think we should be careful with terminology like ending the conflict. A ceasefire is, by definition, temporary, certainly when it comes to the enemies Israel faces now, be it Hamas, be it Hezbollah in Lebanon, be it Iran, or like Hezbollah and Hamas, other Iranian-linked militias in the region. As far as they're concerned, there is no prospect for peace or even diplomatic engagement with Israel. So any cessation of hostilities, any suspension would be, by definition, temporary. Now, Israel knows this. Israel feels that after the October 7th attack by Hamas on its southern towns and army bases, it feels that this was a game changer. It was definitely constituted massive losses for Israel. And Israel now, in turn, wants to change the rules of the game, meaning it insists that any truce in Gaza, that under any truce, it retained the right to resume fighting for what it would describe as the ultimate destruction of Hamas. Now, Hamas obviously does not want this, neither presumably would Hamas's allies in Lebanon, in Syria, or indeed its sponsor, Iran. So basically what we're talking about now is a stopgap measure, something temporary to stanch the violence, and perhaps let cooler heads come in and assess where to take this conflict in the months and perhaps years ahead. But why it has now resurfaced is because of the obvious linkage. World powers and regional powers are worried about what it would mean if Iran now attacks Israel directly, if Hezbollah significantly increases its attacks on Israel as part of their retaliatory actions for the 2 assassinations that took place last week, if Israel lashes out, and indeed this becomes a full-blown regional war. So a Gaza truce would not only slow or ease the fighting in Gaza, it would actually have ramifications for the rest of the region.
In Jerusalem, thank you.
What about quantum computing? People talk about that. Is that something that I should be looking at investing in?
I've made a lot of mistakes, betting on these new technologies like AR, VR turns out to be not so big, 3D printing turns out to be not so big. My estimate is $100 trillion was invested in today's dollar in the PC, CPU-based infrastructure. All this is going to get ripped out to put $100 trillion or more in now a GPU-based infrastructure. In that sort of quantum of numbers, I feel that the quantum computing is going to be very small.
You always are worried about, I presume, geopolitical events. So are there some geopolitical events you're worried about right now?
Yes. I don't know why, but for some reason, I love thinking about black swans. And at the office, everybody thinks I'm weird because I'm always thinking about what can go wrong. But underpinning the AI is the chips. And the chips, despite the CHIP Act, which I think was a good idea for the US, I still think like 80% or so of the capex of TSM is in Taiwan. And so at the leading edge, a lot of capacity is in one very small area. Forget that it's just in China, it's in a very small area. I think that's very risky.
Global headquarters in New York. It is Bloomberg Brief with me, Manus Cranny. Let's set your agenda. Stocks stumble lower by mega tech as JP Morgan assesses the unwind of the carry trade to be 75% complete. Focus turns to the jobless claims today. It's a media blitz. Warner Brothers takes a $9 billion write-down on its TV networks, and Disney feels the pinch and its by the consumer in its parks division. Vice President Harris and Governor Tim Walz pick up momentum in the Midwest as they visit Michigan and Wisconsin to sell voters their message. This is J.D. Vance, mirrors the schedule. A very good morning. The road to hell is paved with good intentions. Equity markets are struggling for a clear narrative. Cathie Wood has been in buying the dip. She's been buying Amazon. She's been buying Meta and Roku. Are you as brave? S&P 500, 52.20 is where we are. Technicals seem to be part of the narrative that is holding the dam on the downside. It will be jobless claims today. 240,000 is the number to focus on. Now, when it comes to understanding the consumer, Warner Brothers are building the streaming business, but they're taking a $9 billion hit on the traditional linear TV, CNN, TNT, $9 billion hit, stock down 12% at the moment. Disney tells you something much more prescient. It is about the consumer. This stock was under pressure. The park side of the business, demand, moderating consumer demand exceeds our previous expectations. That tells you that not just are people perhaps buying less in McDonald's and traveling and booking less Airbnbs, but also pinching on the spend. The bond market is where we had a slight choke yesterday. The bid to cover ratio was lower than we anticipated. There was a mountain of high-grade issuance yesterday, $31.8 billion. And the question now becomes, this backup in yield that you've seen over the past 4 days as the Bank of Japan delivered the covered, is that done? Or do we take another run on the downside on yield? NASDAQ coming back to flat at the moment. And dollar yen, as you can see there, I mean, it tanked. And yesterday's pivot post the Bank of Japan, it just seems to be struggling at the moment. Is the carry trade really all undone? That's something that we can debate in just a moment. Now, Bloomberg had an exclusive catch-up with the economist Nouriel Roubini on the pessimism in the market.
The markets are often wrong about what's going on with the economy and what the Fed is going to be doing. There is some significant, evidence of some slowdown of the economy, but I don't think the data suggests that we're going to have a hard landing anytime soon. If anything, actually, there's some elements of strength in the economy.
It's always special when Nouriel actually finds something good to say about the economy, hence the reason why we played it. Laurie Calvasina joins me now. She is the U.S. equity strategy head over at RBC. Good morning, good to see you.
Good to see you too.
When I find something from Nouriel which is upbeat, I'll take a hold of it. Look, there's lots of ways to look at this market. I still get the sense that there is, and I think this you too would agree with this, there's a vulnerability here.
Yeah.
How vulnerable are we to an aftershock and a ripple through?
So, I think we've got to watch the price action in here. And I know as an equity strategist, it is my job to tell you where that is going to go. But I do think the fact that we've been holding and we haven't really broken the 5,100 mark, we haven't gone down beyond 10%, I think that's a good data point in here. I do think coming into this, we were, not necessarily flagging the yen carry trade, but the idea that we were vulnerable for a lot of different reasons, I think that's all come to play this week. And obviously the yen carry trade, what happened with the economic data last week, that's all front and center. But we also had stretched sentiment on a variety of indicators that were basically telling me for a while, regardless of what the issue was, we were vulnerable to some downside. And you saw that on AAII, where net bullishness had a couple times over the last month or so gotten up above the 1 standard deviation mark on the 4-week average. That's been a very, very good sell signal in recent years for temporary kind of 5 to 10% type pullbacks. CFTC data, which comes out on Fridays, is even scarier. S&P contracts and broader U.S. equity market future contracts have been sitting above your January 2018 highs and above your February 2020 highs. I mean, it's really, quite staggering. We've been sitting there for a while this year. It's surprising to me we only did 5% back in April.
So, we're holding the line at the moment, as you said. 51 is holding the line. If I look at this story around the carry trade, and by the way, I'd be delighted to know if anybody can actually quantify an OTC FX market and say to me, absolutely 75% of this carry trade has been undone. Do you put credence with that? I mean, they're talking about the spot market.
Yeah. Look, I think that's an area, it's beyond my area of expertise. I watch the headlines that everyone else is watching. I am, feeling a little bit better, right? We've got one major bank coming and saying we're sort of late innings. For me, what I'm really watching more are the technicals. And I'm not a technical strategist, but I am listening to that community very closely. And so the fact that the technicals are kind of holding in and the market is behaving when we're, getting sort of close to important support levels, I think that's probably the best we're going to be able to do, because we're probably not going to know officially it's done until after the fact.
Look, if I look at the past 5 days, it has been about growth, it's been about policy response. I would say the shakedown was more in FX and crypto and rates, to me.
Yeah.
That the equity market got some cover from the Bank of Japan yesterday, but the next leg for steadying this equity market is still going to be about the earnings, isn't it?
Yeah, I think that's fair. And I think one of the reasons why, equity investors in my world, and I talk mostly to long-only folks, some hedge funds, but I would say the long-only world that's sort of caught up in the less day-to-day moves, they look at events like these, the fact that we know that there was something flow-driven, something positioning-driven, that almost makes it a little bit better, right, if it's not entirely fundamental, because I think experienced investors who have done this for many decades know you look for, babies that are thrown out with the bathwater in these kinds of situations. You look for opportunities. And I think that is why it's so important to sort of understand where we're going to stabilize. If this thing breaks 10%, it probably means we're going into growth scare territory. Those drawdowns end up being something like, kind of 14 to 19% if you look at post-GFC history. So I think there's an inclination to sort of use this as a buying opportunity, but we need a little bit more information to make sure it's just that.
I mean, if the dam breaks at 5,100, so the next leg could be to 14, could be to 19%.
Yeah.
That then brings in what is the scale of the Fed? The Fed is not here to defend, as I said on Monday, over-levered, AI hunting, AI FOMO investors. The Fed's job is inflation and full employment, right? But then the argument becomes what kind of response mechanism you get from the Fed, whether there is justification for 50, 25, 25, or something more substantive. And again, we haven't seen that kind of response mechanism since 2007.
Right, and if you go back and look at the history of emergency cuts or 50 basis point cuts, we did this last year at SVB. We dusted that work off again earlier this week. You really have only seen that in sort of my career trajectory. I started back in 2000. Let's rewind a little bit to 1998. But if you kind of go with and I'm kind of a dinosaur these days.
You've got a lead on me. Let's put it that way. I've been around longer than you. Go on.
Yeah, but I was always the youngin', but now I'm old. But I will say, just sort of in what I call modern market history, we only break these things out around the terrorist attacks of 9/11, the implosion of the tech bubble, COVID, the GFC.
Yes.
I mentioned growth scares earlier. We had those kind of 15, 19-ish% drawdowns, things like 2010, 2011, the U.S. debt downgrade, the sovereign debt crisis, 2015, 2016 industrial recession. Do you remember any 50 basis point cuts or emergency cuts then? I don't.
No. You say that, look, they come along in bunches, but they don't tend to settle the market nerves.
Not initially, and we have one chart, we've looked at it against the VIX, sort of these emergency cuts and these 50 basis point cuts, and you often see, you know, volatility will continue to rise after you get the first one or two.
And I think that's what people are worried about, is if they pull the ripcord and they do the 50 basis points, what do they know about growth that perhaps we don't? If Danny was here, I know that she'd want. This is homage to Danny. This is about small caps. I mean, you know, we had the rush of blood into that July move. It really was quite strong into value, and that has somewhat dissipated. We've got a nice chart that shows this. So this was the ramp higher in value to growth. Now, look, it's given it back. I mean, big growth, big megatech had a tough time in July anyway. That is far from done.
No, it is. And if
that retracement, excuse me, is far from done.
And if you look at the valuation data, so we look at the top 10 names in the S&P over time, we rebalance it. I mean, you got up to around a 32 times PE multiple heading into this, right? And then it got knocked back down. 30 has kind of been the ceiling. This cohort of the market cannot handle going above the high 20s for too long. And we've come back down into like the mid to high 20s. But the average is like 18. So we're nowhere near, you know, sort of close to levels where you say, okay, we've pulled the valuation froth out. If you look at the CFTC data, and we'll get that on Friday, but we look at the NASDAQ 100 mini futures positioning there, the best proxy we have for sort of real-time positioning and sentiment on the mega cap growth trade. And 2 Tuesdays ago, so the data we got this past Friday, you had barely seen a decline off of all-time highs, which had matched highs that we'd seen back in February. So in terms of the kind of unwind from the positioning and valuation side, I think you've done a little bit more work on the valuation side. You've really barely gotten started on the positioning side.
I know you can't dig into individual names, but when I see moves in when I see moves in Airbnb, like I saw yesterday, when I see moves in Heineken, Delta, and Nike, the verbiage coming from them, that tells me something much more malevolent about the risk to the hedonism of the US consumer. Disney, they're not spending the same amount of money in the parks. It's expensive. Idiosyncratic information, but it's piling up.
It is piling up. I mean, I think we have to ask, what is it speaking to? So again, I think we're all watching the claims data, we're all watching the jobs growth data. I think that's ultimately what we've got to keep focused on, because we've known for quite some time the consumer, even the middle to high-end consumer, is really ticked off about inflation and reacting. I mean, we've been seeing this in company reports for a while. I have small children. I live and breathe this every day with $5 cookies that I say no to. I mean, it's just ridiculous, you know, how much the prices have come up. And you hear a lot of talk about the cumulative impact of inflation. I think a lot of people are living and breathing that, and so you are seeing consumers react to that. We have to disaggregate that, right, from the jobs picture, because while the NFP data, you know, I think it confused people, the weather impacts, clearly we're slowing. Do we really know that corporates are doing anything more than slowing their hiring right now? We're not seeing big pickups in things like the Challenger data. As I go through, you know, kind of non-consumer companies, I am not seeing corporates kind of raise the red flag. I'm not seeing an alarmist tone. I'm not seeing an emphasis on cost cutting that's escalated versus what I have before.
Look, I think, as you said, we've known for quite a while that the consumer is under pressure. I think this narrative that we're sort of going to return to 2% inflation and stay there for a long period of time, that's the bigger question. It's about what inflationary environment do you, me, and your kids have to grow up with.
Yeah, I think that's fair.
Laurie, thank you so much. It's always great to get you in the seat. Laurie Calvasina there of RBC Capital Markets. My guest this morning on equities. Coming up, VP Harris and her running mate, Tim Walz, hitting the campaign trail. Ohio Senator J.D. Vance. He isn't far behind them. Tracking the trail on Bloomberg.
Access the financial world on demand. Hear from leading economists, policymakers, and industry experts via live and on-demand webinars, only from Bloomberg. Start exploring to see what's moving the markets. Visit Bloomberg.com/webinars.
Do you think it'll be the case where someday you will be an investment committee or I'll be an investment committee and we just apply AI, decide whether it's a good deal or not, or we're not going to be there anytime soon?
I don't think we'll be there in the near term. And David, because being on investment committees, there's the analytics of the math, there's the people, and then there's judgment. So analytics of the math, I think AI will help us get way more refined. Right now, we have analysts building models upon models. Our typical investment memo is 86 pages. So we could refine that down very, very seamlessly to pieces. The people aspect to it, to make a judgment call on, do I believe this entrepreneur is going to go the next mile? Do I believe that the background of the entrepreneur, who they are, what they stand for, their values, their family, that's the harder one. I think AI is going to take some time to get there. And then the final piece ends up being judgment. And I don't believe we've seen anything yet that gives us a sense of judgment that we're able to apply.
Brief. I'm Manus Cranny in New York. A very good morning to you. Back to Warner Brothers Discovery. Parent company of CNN and TNT posted a $9 billion charge after writing down the value of the TV networks. For more on the results, Charlie Wells joins us now. Charlie, $9 billion is a heck of a write-down on those legacy assets. What's it going to mean for strategy for this company?
Yeah, Manus, it's tricky. I mean, what was really striking yesterday was that figure, but not just the figure, but how rapidly the company had to comment on that write-down, right? It was only 2 years ago that Warner Brothers and Discovery merged, and I think this is what really was sticking out to investors yesterday as the share price, dropped 9.9% at one point. As far as strategy, it's difficult. I mean, there has been a lot of chatter about the potential necessity of selling assets, but that's something that we know this company doesn't want to do. And actually, if you look across the industry, if you think about the likes of Paramount, if you think about a lot of these other big companies, they don't like doing that.
No, they don't. And I think, as the CEO sort of said, look, a lot of options are on the table. There's been a lot of speculation about splitting that company up. Let's talk about Disney, because they posted the first ever profit. This was on their streaming business. But there's all weakness on the theme parks, I should say. Here's what the CFO had to say.
The lower income consumers are a little bit stressed and shaving a little bit off of their time at the park. And then higher income consumers are tending to travel overseas a little bit more right now. So we really just see this as a few quarters of slight perturbation in the numbers. Frankly, I think we're going to be right back as we get into the middle of next year.
Of course, the CFO, telling the story that they're going to be back on top next year. But if I compare and contrast WBD with Disney, whose shares have also fallen, but by a much lesser degree. So somebody's getting something right in the streaming department.
Yeah, that's exactly right. I mean, look, streaming, that streaming unit at Disney, profitable for the first time ever. But I think what's really probably frustrating for that company is, good news at Disney and also at other companies, good news isn't good enough, right? So they had their first profitability for that unit. We even saw at Warner Brothers, improvements in streaming, and we've been seeing this across the industry. But look, it's just so different from terrestrial, right? The ad dollars are just different. Those legacy TV properties form such a huge part of these businesses, but at least at Disney, there's strength in that unit. Interestingly, earlier this week, of course, we heard about Disney Plus prices potentially going up as much as 25%, which is going to upset some consumers. But for investors, it just shows that this company, at least, right now, thinks that they have that pricing power.
Yeah, I mean, that's a heck of a price rise, isn't it? 25%. Let's see whether the consumer chews on that or chokes. Paramount reports after the market closed today. What can we expect?
I mean, look, it's not going to necessarily be a stellar report, but all eyes really are on that deal with Skydance. And Manus, you and I have been talking about this deal, the twists and turns for the past few weeks. And I think what's interesting here was an element of that deal was this 45-day go shop period. So we are ticking to the end of that, and that would have allowed other suitors to come for Paramount. You know, anything could happen at this point, but I think really the focus is going to be on Skydance, because there's not a lot that this company can really do. There's not a lot of catalysts.
Okay, let's see what the numbers are. As you say, all eyes down on the strategy. Charlie, thank you very much. Charlie Wells with the very latest on the media platforms. Let's turn our attention to the White House race. Vice President Kamala Harris and her running mate, Minnesota Governor Tim Walz, took their campaign to the crucial Midwest swing states to sell the voters their message on the economy. Meanwhile, the former president, Donald Trump's running mate, Ohio Senator J.D. Vance, was hot on their heels in Wisconsin to attack the Democratic ticket. Let's bring in Bloomberg Law reporter Diego Erez Munoz. Diego, good to have you with us. So Walz and Harris really out there bolstering the message with the unions. This is critically important pillar of support. What do we know about their stances on labor? Is it materially different to the Biden presentation? He was on the picket lines with the unions during the auto strike. He was there front and center. How co-joined are Harris and Walz on this?
So I don't think it's materially different. I think Harris and Walz will certainly try to, if elected to office, would try to continue Biden's labor agenda. He has called himself the most pro-union president of the history of the United States, and I believe both Harris and Walz would try to continue that record. Walz, particularly over the last 2 years since Democrats took over the Minnesota State House, has passed a series of longtime Democratic priorities for labor policy, a comprehensive paid leave program. He has signed a ban on non-compete agreements. He has also signed stricter workplace safety laws for warehouse workers and child labor. So the unions like him. They were quick to support his pick after Harris made it. The UAW, the AFL-CIO, both were very quick to endorse him. So the unions are very happy with this decision.
Yeah, I'm just looking at the Washington Post article. Harris and Walz rallied more than 12,000 boisterous supporters outdoors, while Vance appeared to have a handful of workers at an aviation factory. At an event very much designed for the media. Let's just talk a little bit about the strategy here, because Vance is on that trail, mirror image of the vice president and her running mate. I mean, what do we know about this as part of the strategy? What was the narrative from him?
So Vance and former President Donald Trump are both also looking to get that labor vote. That labor voters are a key constituency in those Midwestern states that will prove crucial for the election in November. And Donald Trump, when he won in 2016, had that constituency. So I think he wants to repeat that. And Vance certainly has had a more pro-worker rhetoric than other Republican candidates. But I think the concern for a lot of unions, when speaking of former President Trump and J.D. Vance, is that once Trump did come into office in 2017, his policies were mostly similar to former Republican presidents and were not as union friendly. So I believe that they're taking a lot of what former President Trump and J.D. Vance say on the campaign trail with a grain of salt.
Okay, Diego, thank you so much for joining me this morning. That is Diego Erez Munoz of Bloomberg Law. Coming up the show, earnings, economic data were focused razor sharp on the jobless claims. Context matters every day on Bloomberg. Good morning from New York.
Bloomberg has enhanced search on the terminal to deliver what you need when you need it. Now, you can simply type phrases in everyday English in the command line. Compare financials. Find people. Analyze markets. You can enter phrases or ask questions. What do you want to know today? Ask a question or visit SearchGo to find answers now.
DOJ or other authorities.
Could face bigger challenges next.
It was going to keep bringing the World Cup. This is a three.
As the economic picture.
Covering the intersections of Hollywood, Silicon Valley, and beyond.
A lot's happening on Wall Street.
I couldn't have been more wrong.
It's going to stay volatile for a while longer.
It's a bifurcated market.
Need to catch up?
This is Bloomberg Wall Street Week. I'm David Weston.
We've got the information and insight.
Year over year, you could start to see some cracks.
It might be overhyped short term, but it's underhyped long term.
From businesses most influential and instrumental.
A lot of the doom and gloom has been somewhat overblown.
If you're not living near the edge, you're taking up too much space.
Bloomberg Wall Street Week, only on Bloomberg TV and radio. Context changes everything. Bloomberg loves earnings.
I know it's like your Super Bowl, right?
I can't wait. It's like opening presents in the morning.
All right, it will be exciting.
Nobody covers earnings like Bloomberg.
Here's your Bloomberg Brief. I'm Manus Cranny in New York. A look ahead for today. We have earnings from Eli Lilly and Novavax before the bell. And then it really is all eyes down for those jobless claims. The initial jobless claims, 240,000 is what we are expecting. Continuing claims, 1.871 million. So that is going to be a real focus for this market post that jobs number last Friday. Expedia and Paramount earnings will hit the tape after the bell. Some micro movers for you. This is a pretty big one. Bumble, plunging after the dating app says it's slashing its annual revenue outlook despite the overhaul. Warner Brothers, we talked about that several times this morning, down over 12%, $9 billion charge on writing down their traditional TV assets. And Occidental Petroleum raised their production and their capex plans for this year, closing at $10.8 billion acquisition for Crown Rock a little bit earlier this month. Stock is up 0.7%. I want to show you the S&P 500. Laurie Calvasina of RBC has just sat in the seat with me. Critically important, 5,100 is going to be your line in the sand. That slips over and flips over from what she would refer to as a potential holding the line on a 10% drawdown to a growth scare. And in that event, you're looking at a traditionally 14 to 19% drop in these markets. All eyes down on the jobless claims today. Good morning from New York.
Middle East and Africa. Vibrant resources and high-yield investment opportunities abound. Join me on Horizons Middle East and Africa for the stories, newsmakers, and insight from this exciting region. Now weekdays, only on Bloomberg.
Time to start the cutting cycle, but we don't see
evidence of a recession yet, and the soft landing is still in play here.
I don't think the data suggests that we're going to have a hard landing anytime soon.
These trends have been underway, they're persisting, and our fear is that the soft landing could be slipping away.
The bad news is no longer the good news. I think bad news is not bad news.
The Fed needs to regain control of the economy. Unless you establish anchors, the volatility itself of the marketplace will undermine economic well-being.
This is Bloomberg Surveillance with Jonathan Ferro, Lisa Abramowitz, and Anne-Marie Hordern.
Spent the week with everyone freaking out and Rabini's kind of chill. I really don't know what to make of that. Live from New York City this morning. Good morning for our audience worldwide. Bloomberg Surveillance starts right now, coming into Thursday and heading towards a fourth week of losses on the S&P 500. Your scores look like this. More of the same, maybe. We're pulling back by 1/4% on the S&P 500, down 1/10 on the NASDAQ. On the Russell, we're down 0.5%. Yesterday, giving up gains of as much as 1.7% in yesterday's session. Today's data point of the morning, arguably the data point of the week, it's jobless claims. The estimates look like this. 240 is the number we're looking for in our survey. Anne-Marie, the number last week, 249. This one has become more and more important.
A lot more important, and what they are expecting, though, is that a 9,000 drop in those initial claims. Jim Reed this morning, Deutsche Bank, billing it as one of the most important data points of the day and potentially of the week. The increase last week, what we saw, though, there's some seasonality to this. Auto factories are closing. You do have some school closures. Of course, the hurricane in Texas. But yet again, what did Mohamed El-Arian say to us yesterday? This is a market that feels anchorless. And any data point that comes out, potentially, they're going to want to really get their handle on.
We're at the highs of the year on jobless claims and hoping that we pull back just a touch. The calendar for the month ahead, let's go through it again. I think it's worth revisiting. We have a Federal Reserve decision on September 18th. The meeting begins on September 17th. We've got a CPI report on the 14th of August. Jackson Hole and the speech that traditionally gets given by the chairman, that takes place on August 23rd. Payrolls again on September 6th, CPI on September 11th. Danny, that's the lineup, really, the big data points between now and September 18th.
And the reason it's particularly frightening this time is just how the market is shaped up going into it. We have bond yields basically right back where they were before we got the Friday jobs report. We're talking to Ian Lingen yesterday at BMO, who said that positioning is back neutral. That means the chop this time could happen either way. You get this feeling that the trend has stopped, the trend of before the summer, and when trend stops, you get a lot of instability as we try to grasp on to what the economy is actually going and where it's actually going. That's why these data points are so important.
Dollar yen check, 146 right now. Have we dealt with that? Is that all unwound? Are we finished?
Well, depending on who you listen to, John. JP Morgan says that we are, I think, 3/4 of the way through, but everyone's got their own estimate. If you look at the Bank of Japan meeting minutes, it would suggest that maybe we're not through. It was hawkish. The market has read it as hawkish, and the reaction, you can see that clearly.
Dollar yen right now, 146, pulling back by 0.4%. Bramo's not here. Bramo's back next week, but if Bramo was here, we'd be talking about that soft 10-year auction of yesterday and looking ahead to this one, a 30-year auction a little bit later this afternoon, $25 billion worth. We'll talk about that a little bit later. Your bond market right now looks like this on treasuries at the moment. We'll start with the 10-year maturity. The 10-year at the moment, your yield lower by 3 basis points. The 10-year 390.93 in the equity market, pulling back just a touch. We're down 0.4% and pretty much unchanged for the euro against the dollar at 109.25. The lineup for this hour coming up, Seema Shah of Principal Asset Management as stocks drop ahead of key data. Tobin Marcus of Wolfe Research as Harris makes her way through the Midwest, and Sarah Wolf of Morgan Stanley on the state of the U.S. labor market. We begin with our top story. Stocks sliding going into jobless claims at 8:30 Eastern time. Seema Shah of Principal Asset Management thinks it will take a lot to end this bout of volatility. Unfortunately for markets, the negativity of the current narrative implies it may take a combination of solid economic data, earnings, and reassuring Fed speak to settle nerves. Seema joins us now for more. Seema, let's take it from the top then and go through it point by point. The Federal Reserve, the Fed speak, the earnings, and the data. Just where are we at the moment?
We haven't got that much. Unfortunately, there's not much Fed speak between now and Jackson Hole. I'd expect a couple more speakers to be coming out to calm the market. The thing is that, just as we are all reacting to the economic data as it comes out, that is also the case for the Fed. So they can tell us that things don't look so bad. They can reassure us that the labor market doesn't, the payrolls print of last week is just one data point. But of course, if you were to see a continued deterioration in the data, well, the Fed themselves are going to have to respond in kind.
What is driving things here, Seema? What's amazing about this shock of the last week, if we can call it that, is for many people, they're still trying to diagnose the origins of it. Is this a growth scare born in America, or the vicious unwind of the carry trade out of Tokyo, Japan? Where do you place the greater emphasis?
Well, I would say that, look, for the last 6 weeks to 2 months, I have seen the number of client queries moving towards worrying about actually recession has been quite surprising. So we've moved away from wondering, is the economy going to continue to accelerate? Is there an overheating? To people really questioning how weak the economy is. So in a way, I do think this is a growth scare. I don't actually buy into it, but I do think a lot of it is born of a growth scare, and then it's been exacerbated by this very, very low liquidity. I think the three of you are the only ones left in New York this week. So that hasn't helped. And then, of course, there's positioning, the carry trade. So it's been a bit of a perfect storm of events. But I think that the growth scare has actually been building up in people's concerns for a while.
Seema, what does that mean for the data coming in, not just this week? John went through the calendar, PPI, CPI, and retail sales next week. Are you worried?
I don't think I'm worried, because I think when we look at the breadth of the data, we do believe that there's still a lot of resilience, particularly in household balance sheets and corporate balance sheets. And what that should mean is that if you were to see a deteriorating labour market, it shouldn't then mutate into a hard landing. But we have to also be aware that job losses can be quite self-reinforcing. Job losses lead to further job losses. At this point, though, we're not seeing layoffs. And a lot of the surveys that we're looking at and just kind of watching companies and how they're reporting, you're not really hearing news of that. But of course, the Fed has to be aware that, look, the labour market deterioration, if it continues, well, then that could feed and create a downward spiral. I think that the CPI data, for the first time in ages, that's not the front and center. It's really about the growth data and in particular about the labor market.
Seema, let me actually ask that question another way. Are you worried about the market reaction? Are you worried that this is a market that is putting too much weight on the negative data that's been coming in?
I don't know if it's necessarily putting too much weight. I think it's a market which is on edge. As I said, exacerbated by the fact liquidity is so low. But I think that from here, the direction is fairly unclear over the next 3 or 4 weeks. It's going to respond to how that data comes out. If jobless claims moves further up today, then I think, of course, you're going to see a negative market reaction. If it falls back a bit, then the market is going to celebrate. And I expect that to be the pattern of market moves for the remainder of the month until you get into September, and certainly post-Jackson Hole. At that point, maybe you can see some stabilization in a really clear direction for the market.
We also have the DNC next month, and I bring this up because Lori Calvasino is on with Manus, and on Monday she put out a note saying that the S&P 500 has now been positively correlated with Trump's betting market odds, which have been deteriorating, now lag Harris. Could politics be also one of those pillars, one of those reasons why we are seeing the markets whipsaw, and we saw that sell-off on Monday?
So I think that the political picture actually played out maybe about 3 weeks ago when you had that huge rotation. I do think that the rotation towards small cap was a little bit about the Trump trade. Things are settled at the moment, but you're right in saying that that election story, it's coming back. It's not like it's disappeared. So come September, I think that is probably going to be, again, near the front of the news story along with the Fed. So we will see that add to the volatility and probably impact the market narrative too.
So if all this about September, should, Danny, John, and I, the last 3 people left in New York, is all of this just noise then?
In a way, it's noise. So, I mean, the thing that we're advising clients is like, look away from the near-term headlines. It's fairly shocking. The moves are very, very significant. But we have to have, I think the most important thing is to have an idea of what your fundamental picture is. Now, it's still unfolding because you're at that cusp where you could be pointing to a stable economy. But then, as I said before, if job losses really start to mount, then it feeds further weakness. So, unfortunately, the narrative isn't as clear as it would have been maybe 6 months ago. But the key point is focus on the fundamentals, because the technicals can really whipsaw you around, but it's the fundamentals which are really going to create that clear longer-term trend.
Seema, that's the story. We've got to talk about the price of the story. And in certain parts of the market, we've had quite a big reset. We heard from Barclays yesterday. They were talking about going overweight tech, overweight financials, looking at buying opportunities. Seema, where do you see the opportunities at the moment? Where do you want to be?
So I think the key area is, look, we still think defensive quality. We know we're going into an economic slowdown. We don't think it's going to be a recession, but it does suggest that you need to have a slightly safer element to the portfolio. We do think that fixed income, I mean, it's really proved its worth in the last few days with that negative correlation returning between equities and bonds. And then within, we've maintained an overweight to large cap tech. We're keeping it at some point, probably not yet, but at some point will be a buying opportunity as well.
You say we're not in recession, but I have to say in certain parts of this economy, it certainly feels like we are. If you're a low-income consumer right now, it looks and sounds like recession. If you're in manufacturing, based on the ISM we had, it looks and sounds like recession. Seema, are parts of this market firmly in recession?
So you're absolutely right. There are pockets of the economy which are struggling, and that makes sense because remember, like the Fed did hike a significant amount in a really, really short space of time. So there will be pockets which will be struggling. Lower income households, the ones that really don't have the savings, that haven't benefited from that passive income, the rise in equity prices, rise in house prices, they're the ones who are most leveraged to the interest rate environment, and that's where the weakness is. But remember, for the US economy, the medium and higher income households are the ones that really carry growth. They account for about 60 to 70% of consumer spending. So as long as they are okay and the lower income households are not really struggling significantly with job layoffs, then I think the US economy, it's slowing, but we're not heading towards recession. But you're right, there is a very, very differentiated environment underneath the surface for the US economy.
Well, Seema, just given the noise that's been around this earnings season, you would assume that it looks pretty bad, that you've had all these companies from airlines to autos talking about how bad things are for the consumer. But Deutsche Bank's Binky Chaudhry points out that earnings are on track to rise the most in 8 quarters, at 10% quarter over quarter for this one. Do you take comfort in that? I mean, are we overlooking what is otherwise a strong earnings season?
Yeah, I was thinking exactly the same thing today. When you think about the narrative, you'd suggest that maybe earnings picture has been horrendous this season. It really hasn't. But I think the thing is that we came into the earnings season with people, as I said, really worried about what is happening with the growth backdrop, but also looking at the valuations of some of those big tech firms and starting to wonder if they would deliver. So I think that has almost encompassed the entire narrative and hidden the fact that actually under the bonnet, it doesn't look that bad. There has been a broadening out of the stronger earnings performance, and some other sectors, not just big tech, and actually the opposite of big tech, are really the ones who are performing well. And that is a really, I think, encouraging sign for the remainder of the year.
Seema, it's good to catch up, as always. Seema Shah, Principal Asset Management, talking about what's under the bonnet. Depends what car you're driving. Just think about this. Let's lift the bonnet on the US consumer right now. Pepsi, consumer is more challenged. The airlines, we're losing pricing power. That's a story, by the way, you heard on both sides of the Atlantic, not just the US players, but the likes of Ryanair as well. Kimberly-Clark, slower price increases. Disney yesterday, low-income consumer is pulling back. And then they said something that I'm still scratching my head about, that we'll be back in business, we'll be bouncing back by the middle of next year. And I'm still sitting here thinking, where does that come from? What drives that?
Right. Is it people who are middle upper class not going overseas anymore and instead going to Disney, which you actually might assume that could be generally a bad thing for the economy because people aren't spending as much. There was a decking company yesterday. They're called Trex, and I thought their earnings were specifically interesting because on the earnings call, they said, look, we don't have lower income consumers, people who want to redo their decks in a really fancy way. They don't tend to be lower income. Instead, we have middle income consumers, and they are struggling. They're struggling, and they don't want to do renovations to their house anymore. So we've been talking about the lower end consumer, but there are kind of hints it might be climbing up.
Is this migrating up to high income consumers? And I think that's the big question. I think it was Chris Harvey of Wells Fargo that was asking that question a few weeks ago. Starting to see just a little bit more evidence of that. Let's take the opportunity to get you an update on stories elsewhere this morning with your Bloomberg Brief. Here's Yahira Hackers. Hey, Yahira.
Hi, John. Taylor Swift's 3 shows in Austria this week have been canceled after local police arrested 2 people on suspicion of planning a terrorist attack. A government spokesperson saying the decision was made by the event organizer. Officials found chemical substances at the home of a 19-year-old Austrian citizen and later detained another person in Vienna. Shares of Warner Brothers are down more than 12% in the pre-market. The parent of CNN and TNT posted a second quarter charge of more than $9 billion after writing down the value of its traditional TV networks. The write-down reflects the continued exodus of viewers from cable networks like CNN to new streaming platforms. On that note, Warner Brothers said it added 3.6 million new streaming subscribers, almost double what Wall Street had expected.
And shares of Bumble are plunging nearly 40% in the pre-market. The dating company reporting second quarter revenue that missed estimates and slashing its revenue outlook for the year. In contrast, Match, which owns Bumble's biggest rival, Tinder, jumped the most in nearly 2 years last week when it delivered better than expected quarterly results. That's your Bloomberg Brief. John?
Yahara, thank you. Let's stop getting hammered. More from Yahara in about 30 minutes' time. Up next on the program, the battle for swing states.
I just wanted to check out my future plane, but I also wanted to go say hello to the vice president and ask her why Kamala Harris why does she refuse to answer questions from the media?
That conversation up next, live from New York City this morning. Good morning.
This is Bloomberg News Now.
News when you want it at the touch of a button.
Another volatile day on Wall Street. We're seeing big moves.
All eyes on Capitol Hill as Democrats and Republicans prepare.
Today's job numbers casting doubt on the Fed's next move. Inflation remains front and center. And that's news when you want it with Bloomberg News Now. Get it 24/7 on the Bloomberg Business app, Bloomberg.com, and anywhere you get your podcasts.
Bloomberg News Now. Context changes everything.
Good morning. This is Bloomberg Surveillance.
Welcome back to the opening trade.
This is Bloomberg Technology.
This is the Asia Trade.
You're watching the close.
Welcome to Balance of Power.
This is Bloomberg.
Equity futures on the S&P 500, slightly negative. If you are just joining us, welcome to the program. In the bond market, sloppy 10-year supply yesterday. That shook up this bond market a little bit firmer this morning. We're down by 2 or 3 basis points, 391.69 on a 10-year. That's the market. Under surveillance this morning, the battle for swing states.
I just wanted to check out my future plane, but I also wanted to go say hello to the vice president and ask her why Kamala Harris why does she refuse to answer questions from the media? And I also thought that the press gaggle following her might get a little lonely. I at least have enough respect for you all and for the American people you report to come and talk to you and to answer some questions. And so I thought her reporters might actually benefit from that as well.
I think that was met with the sound of silence. Here's the latest. The Harris Waltz ticket is heading to Phoenix, Arizona for the next stop of their swing state tour. J.D. Vance shadowing the campaign with his own rallies to undercut recent momentum behind the Harris campaign. Tobin Marcus of Wolf Research writes this: "We still think it's premature to consider Harris an outright favorite, which still give a slight edge to Trump." Tobin Marcus joins us now for more. Tobin, great to catch up with you, sir, as always. Seen just a full aircraft hangar. And it just reminded me of like 2016 and Donald Trump. They seem to be taking a leaf out of his playbook from 8 years ago, Tobin, and it looks to be highly effective. They look like they have some real momentum in the Harris campaign. Yet J.D. Vance is right. We haven't heard Harris answer any questions at all, with the exception of standing on the tarmac following a prisoner exchange. And Tobin, I wonder if that's going to change at all anytime soon, and whether actually it needs to.
So right now, I think they are trying not to mess with the good thing. It's been a very, very, very good 2.5-week run for Harris since she took over the top of the ticket. And I think that they are reveling in the momentum that they're seeing out there and sort of not feeling the need to take any unprompted questions if they're getting their message across, right? The point of the campaign is to deliver their message. They feel like they're doing that. They're getting tons of earned media, most of it positive, but certainly there's no lack of attention. And so I think they are not going to feel immediately compelled to change their media strategy. Although, as the campaign goes on, I do think that we're going to have to see a little more kind of unprompted answering of questions. But I mean, frankly, both Harris and Trump are not taking a sort of press conference forward approach. We're seeing a lot of appearances on alternative media. Trump going on, I guess Kick was the streaming platform that he was on the other week, which sort of similarly is an unorthodox media strategy.
Right, but he also did just sit down with our colleagues at Business Week to talk about a number of policies, something we haven't seen from Kamala Harris. At what point do you think they'll actually come up with an agenda for what their policy plans would be if they win the White House?
Well, they have to put out a platform for the Democratic National Convention, which is in 2 weeks. So we'll see something before too long that sort of purports to be the official agenda of the Democratic Party. And those platforms generally are not that informative about what anyone is planning to do. They're a little bit of an interest group management exercise, particularly on the Democratic side. Trump took a more active role in setting the RNC agenda this year. And frankly, I think it would be wise for Harris to sort of similarly lay out something that's kind of streamlined and reflects what she personally wants to prioritize rather than some incredibly detailed, 14-point plan on every single policy issue under the sun. So, before too long, we should see her put out something. But, it's a short campaign. The shorter the campaign is, the less I think she's going to have to answer all these tough questions about exactly what's your agenda on paid family leaves. You talk about that. I think probably she can just sort of state a priority for the issue that she wants to focus on and leave some of the details for after the election.
The short campaign works for her, and Washington Post had a story where the former president, Donald Trump, apparently said to someone, I already beat Biden. Now I have to go out and prove myself against her. How should the Trump campaign be dealing with this? Because we just showed pictures of her rallies. She's getting a lot of people, and there's a lot of excitement around her and her new VP pick, Governor Walz.
Well, their strategy, I think, has always been to portray her as kind of dangerously liberal and out of step with the American people based on her past positions that she took in the 2019-20 primary. She committed to various different things that I think are problematic. One of the reasons why I don't yet consider her a favorite, even though the polling has looked very strong for her, along with that enthusiasm on the ground, is that we haven't really had a chance to see whether or not those attacks are sticking yet. They have not been delivered in the most disciplined way, I would say, from the Trump side. And I think the way that they're intending to tap Walz onto that, sort of attacking nice Minnesota as a socialist hellscape, seems a little bit challenging. But there is plenty of ammunition they have to go after Harris, and we've only started to see that effort come together.
Tobin, that's the content of what they're saying. I want to ask you about how they're saying it. We haven't seen Trump at a rally since Saturday when he was in Georgia. Instead, it's been J.D. Vance, who's been out throughout the Midwest. What do you make of that tactic, that they're basically sending him out to appeal to these voters?
Well, look, I mean, J.D. Vance is from the Midwest. His electoral track record is not particularly impressive in the Midwest. So I don't know how he's going to do as a voter. In Ohio, he ran behind Trump, and he ran way, way, way behind the governor, the Republican governor, who is sort of substantially more popular figure. So he has some affinity, I think, for that part of the electoral map, but it remains to be seen how effective he is as a messenger. Trump's not been running the most sort of vigorous campaign, more so than Biden back when he was on the ticket. But I think on both sides, we do have guys who are a little bit kind of probably past the peak of their powers in terms of their ability to just sort of run a really, really, really aggressive campaign 5 days a week. So, if they want those attacks to stick, I think they are ultimately going to have to get Trump more out there rather than just posting about her on True Social.
Tobin, it just feels like he's trying to beat a man he's already beaten. He's still trying to beat Joe Biden. And Tobin, I wonder why he's finding it so difficult to pivot. We talked about these pivots in the campaign. Clearly the Democratic ticket had to pivot. It's done a great job of doing so. You can see the enthusiasm in the party. You can see that reflected in the polls. Why do you think this campaign is struggling so hard to pivot?
Yeah, so the campaign organization, I think, is pivoting reasonably well. I think if you look at Trump's kind of campaign leadership, they're not feeling too wrong-footed by the need to go after Harris. They feel like they have plenty to say about her, even though, again, that message has not yet come across, and time will tell whether or not they succeed in getting this sort of negative attempt to define her across. But Trump himself, yeah, really does seem to be struggling. I guess there's been a lot of intrigue in D.C. about what exactly is meant by this comma blah nickname that he tries to be, that he seems to be trying to roll out. So it does feel like he personally is sort of throwing some things at the wall and seeing what will stick. Again, we do have 90 days left in the campaign, so he has some time to see if he can make it happen. But for now, not the most effective effort from him.
Tobin, this was great. It's good to hear from you, sir. As always, Tobin Marcus there of Wolf Research. Look, we're still early August. Got a long way to go. And I know a lot of people sit here and say it's a short campaign. Well, we've seen how much can change in just a single month in American politics. But when you sit here and just take stock of where the momentum is, who's got the momentum, it's pretty clear that one ticket has the momentum right now, and the other ticket has kind of lost a lot.
Absolutely. It's the Harris campaign. They have momentum, and they're doing the splits across the U.S. Does that change when she starts to talk about policy? She's very good in these moments. Even yesterday, there was a heckler, and she immediately shut that person down, and the crowd there actually supported her doing that. How does Trump change? In this Washington Post article this morning, he says to an ally on the phone, "It's unfair that I beat him, and now I have to beat her too." It almost feels like they haven't come to the fact that this is a new election. It's just a brand new race. That's what it is.
They're struggling to adapt. And by they, I mean the former president. You can see that quite obviously. If you are just joining us, equity futures negative here by 0.2% on the S&P. Coming up on this program, we'll catch up with Winthin of Brown Brothers Harriman on the unwinding of the carry trade. From New York City, this is Bloomberg.
Names in tech are on Bloomberg.
I don't like anthropomorphizing AI. I sort of believe it's a tool. It is got intelligence, if you want to give it that as moniker, but it's not the same intelligence that I have.
Especially I'm afraid of whenever it's some kind of AI is speaking for me. I want to be myself, and I want to be the one speaking. I have AI myself. actual intelligence.
This industry of producing intelligence is one of the greatest opportunities I've ever seen. Instead of instruction-driven computing, it's now intention-driven computing.
There's been a lot of us who've been working in AI for a long time. It's great now to see other people using it and seeing what some of the challenges are.
To stay ahead in tech, it has to be much more than just software. So you need long-term investments in science and research.
You have an ecosystem of companies coming together. It's causing a new industrial revolution.
Nobody covers technology like Bloomberg. Context changes everything. Welcome to the world of decentralized finance.
With the surge in Bitcoin, you have crypto stocks also surging.
Bloomberg's covering all things crypto, the people,
This is a political attack, and we must hold our elected officials accountable.
the transactions,
Really a record-breaking moment.
Bitcoin is the exit strategy.
and the technology.
Awareness is going to grow, and these things grow the overall industry.
Crypto as an asset class is here to stay.
Bloomberg Crypto, only on Bloomberg.
Live from New York City, welcome to the program. Check out the price action together. Equity futures pulling back just a touch. We're down by about 0.2%. The highs of the session yesterday positive by about 1.7, and then pulled back to negative territory on the S&P 500. We're adding to those losses just a touch this morning. That rally disrupted somewhat by developments in the bond market. So let's look at the bond market. A disappointing bond auction following a ridiculous rally. This bond market caught offside on a 10-year. We're down to about 391.69 this morning, down 2 or 3 basis points. I keep saying this, you've got to think about where we were Monday at the lows on a 2-year. We were at 365, so 30 basis points south of where we are right now. We're down about a single basis point at the moment on a 2-year. Danny, we talked about that 10-year auction. We get a 30-year a little bit later this afternoon, $25 billion worth of 30-year bonds.
Yeah, I mean, it was not a good auction by any stretch of the imagination. Jim Bianco points out that it is tied for the 3rd worst over the past 7 years. If we extrapolate this out, if all of a sudden we're not willing to pay when yields are below 4%, what happens when the economy turns? What happens when yields are much lower? And we have to think not only about that, but of deficit concerns. I think that's when you start to say, okay, we could get some real pain in these auctions.
Political outcomes as well. If we have one candidate who succeeds and ultimately wants to extend all the tax cuts from a few years ago, you've got a very different supply picture potentially to grapple with as well. Zach Griffiths at Credit Sites had this to say about the auction of yesterday. The repricing following what was really just a moderately weak payrolls report seems way overdone. We were caught very offside going into that auction, according to the likes of Credit Sites. That's the bond market. I want to talk about foreign exchange just briefly and give you a snapshot of where dollar yen is trading at the moment. Dollar yen at the moment is down to about 146.26. We're down 1/3 of 1%. More in Japan in just a moment. Under surveillance this morning, traders bracing for jobless claims at 8:30 Eastern Time. Our survey expecting initial claims to come in at 240,000. That would be coming down from the previous week at 249. The figures in sharper focus, obviously, after that weak July payrolls print on Friday. This number, I have to say, it's like the most important jobless claims number I can think of now for a number of months.
Yeah, I mean, I've heard people saying it's basically the most important since, pandemic 2020, when all of a sudden you had this huge upheaval. And it is because we just feel like we're in this no man's land. We've been talking all year about how we've had this narrative pendulum swinging back and forth. At least the pendulum was staying on one side for a couple months. Now it feels like the pendulum is swinging day by day. And each data point we get, the pendulum swings another way. And we've seen what that can do to markets. We've seen how violent both the rally and the unwind can be, which makes this such an important print.
It's so important, but there's so many seasonal issues that can impact this number, which is why I find it almost like hard to imagine that the market wants to put all their eggs in the basket when it comes to this one print. Mohamed Al-Aaron had this to say earlier this morning on Twitter leading up to this. Above 260,000 would feel renewed concerns about the health of the labor market and increase these recession risks. Already we see more banks coming out, increasing that probability. And then below 230,000 would point to gradual and orderly normalization rather than something worse. So I'm trying to look at that range.
Yeah, this isn't just important because of the data we got last week. It's important because this is all we've got. There's nothing else. We've just got jobless claims. We've just got jobless claims, and early this week we just had ISM services, and then for next week, that's when you get a little bit more data. But for this week, this is basically it. So that's the US side of the trade. Let's talk about the Japanese side of the trade. The summary of opinions from the Bank of Japan's July 31 meeting showing officials didn't see their rate hike as policy tightening. Comments suggesting they didn't expect the move to be big enough to disrupt global markets. This coming, of course, after the BOJ said it won't raise interest rates when financial markets are unstable. Mike McKee would say this about the Fed, that you can massage the Federal Reserve minutes to kind of guide them to where you want them to go, to send the message you want to send. Was the message received loud and clear out of Japan today?
Well, you do see strengthening in the yen, so in one way you can say yeah, but a lot of people looked at this and said, it's stale. It doesn't make sense anymore to read this as hawkish because we did have the deputy governor come out and say we're not going to hike when markets are not calm. But I think you look at something like one policy member saying that rates need to go to 1% to reach neutral when they're just 0.25% now. The market might be right in interpreting as a hawkish and not just stale commentary.
You touched on this in the immediate aftermath of this mess, and I think it's so important. What happened? Was this market shakeout the result of a growth shock in America, or just triggered by what happened in Japan and exacerbated by the carry trade unwind? If it's the latter and not the former, but the Fed believes it's the former and not the latter, don't you have a bigger problem?
I'm going to be honest, I'm having a hard time keeping track because it is this weird circular thing that keeps happening. If anything, the problem is that it didn't really take much. It was a couple things coming together, right? It was 15 basis points of a hike. It was us worried about AI. It was us worried about a growth scare. The driver almost doesn't even matter. It's that the market is so vulnerable and can be set off on these various drivers that we can't even pinpoint at this moment. So when you get a quiet week like this, when you have a summer that people aren't trading a lot, it gets you worried, again, about jobless claims, and it gets you even more worried when you have huge data points next week.
Particularly if there's only 3 people left in New York City, according to Sima Shan. Apparently it's us. I don't quite believe it, but here we go. JP Morgan said 3/4 of the global carry trade has now been unwound. Strategists writing in a note, the returns in a group of G10 emerging market and global carry trade baskets tracked by the bank have fallen about 10% since May. Win Thin of Brown Brothers Harriman joins us now for more. Win, it's great to get your insight on this FX market, sir, so let's dive deep into it. How much of this mess have we unwound? What's left?
Well, first of all, thanks for having me. It's always a pleasure. At this point, I think it's all guesswork. We can look at balance sheets, et cetera, after the fact, but this is really quite a moving target. So to me, the carry trade has always been this sort of huge amorphous blob that we can sort of take a stab at, but we sort of ignore it until things kind of blow up. I would just say that going back to your comment earlier, I totally agree that this was a very pretty much a perfect storm. Any of these events by themselves, the BOJ tightening, the dovish Fed, sort of softish U.S. labor market, probably wouldn't have had much impact. But all three together, along with what I think the most important thing is the positioning, led to a really outsized reaction. Market was so one-sided, so complacent about loading up on risk. To me, this unwind, I think, still has quite a bit to go. I think the one thing I'm very confident about is that volatility will remain high, regardless, really going into the fall and perhaps even year end.
When you say quite a bit to go where? Let's just pick a trade, pick a currency pair. Let's say dollar yen. When you say quite a bit to go, what do you mean?
So by quite a bit to go, I mean that to your point earlier, that we don't really have a handle of how the U.S. economy is going, how the global economy is going, and there's a lot of fear right now. As you point out, there's no data this week. Next week we'll get inflation, retail sales, but even then, I don't think that's going to assuage these concerns. The markets have really jumped on this bandwagon of U.S. recession, dovish Fed, and it's going to take a while to sort of unwind those expectations. I'd like to point out the market's been totally wrong about the Fed easing cycle, this whole entire cycle. I think they're wrong again. We're looking at 100 basis points being priced in by year end, something like 200 basis points total over the next 12 months. That is a deep recession. That's the only way we get that rate path, and I just don't see it. The U.S. economy is still holding up. So by quite a ways to go, I think that volatility will remain high as markets wrestle with the data, sort of wrestle with the narrative. But I remain confident the U.S., for now, at least for 2024, is going to avoid recession.
It's one of these weird things, because you talk about this idea that we've, basically we overdid ourselves, that we were too confident, we were complacent. How complacent are we at this very moment? Are we still complacent?
No, I think the markets are actually overly fearful. Again, pricing such an aggressive easing cycle suggests the markets are really concerned about the growth outlook in the U.S., the global growth outlook. So I would say complacency has definitely sort of morphed more into fear, or I think overly fearful. I'm not saying, look, take a break at the champagne and all is good going forward, but I think as you know about the pendulum, it always swings. I think right now the pendulum swung too much in the sort of negative U.S. recession territory.
But when the pendulum swings, I mean, you can be caught really offside in this market. When you can be caught offside in the matter of days, how quickly things are flipping. What do you do with that? How do you want to position and stay in this market when that pendulum is swinging at hyperspeed?
Yeah. No, that's a problem for analysts. And I think my rule of thumb is don't panic during a move. I'm not going to name names, but several banks came out and changed their Fed calls in the middle of this Fed panic, in terms of this market panic. And that's exactly the wrong time and the wrong signal to send to clients. I think you have to kind of look through the noise. This is my philosophy. Look through the noise and look at what's the true signal. What's the fundamental story? And to me, the U.S. is growing somewhere around 2-3% in Q3 after a 2.8% print in Q2. The momentum remains strong. That's why I think there's no recession this year. The momentum is pretty strong going into Q3, Q4. 2025, well, that's a different story. We can revisit that. But, near term, again, I think the fundamental story really hasn't changed, say, from 2 weeks ago. Yeah, the economy's slowing a little bit. There are pockets of weakness. But overall, the U.S. economy remains in solid shape. And that's the story I like to tell.
Well, when you look at pockets of weakness, what exactly are you looking at?
Well, clearly the labor market. As you noted earlier, the claims are edging higher. The Somm rule that we've all been talking about has been triggered, but even Claudia Somm herself has said, "Look, everyone hates to say this, but hey, this time it's different." She points to growth in the labor force as the major factor behind the rise in unemployment, rather than layoffs and job elimination. So, again, there's so many moving parts. I just want to bring this back. One last final point about the carry trade. It's not just about currencies. One of your reporters dug up an IMF article from, I think, 2008, 2009 that suggested that the carry trade is really a big factor in the great financial crisis. It's borrowing in yen and investing in just risk assets, not just high-yielding currencies, but things like mortgage-backed securities and things like that. So I think that's another reason why we had such an outsized global, multi-asset meltdown last week. This carry trade goes beyond just sort of currencies.
I want to also get back to your point about the fact that you think the market is overpricing in how many cuts we're going to get from the Fed this year. If it's not 100 basis points, where do you put it at?
I think, September is clearly a go. I think, to me, it's a debate whether it's 25 or 50. But I don't think the Fed is in any rush. If you look at financial conditions, they remain quite loose. Yeah, sure, we had a little tightening last week with the equity market meltdown, but to me, the market is doing a lot of the lifting, the heavy lifting for the Fed, even without cutting rates. The Fed has seen some easing already ahead of the September 17th, 18th meeting. Mortgage rates are at 2-year lows. So again, my base case is for a soft landing in the U.S. economy, and that to me does not sort of argue for a really aggressive easing cycle that the market's priced in.
Well, before you go, let's just finish on the carry trade, and let's sort of park these cryptic stories about these kind of spooky, mysterious hedge fund managers that are going around shorting one thing and buying US tech. Can we just talk about the Japanese investor when I just want to understand how dominant the Japanese investor has been in being structurally short their own currency and being long assets around the world, and whether that money is going to start to come home now after what the BOJ started last week.
Yeah, Jonathan, that's a great point. And that was always sort of the 800-pound gorilla that was sort of in the room before the BOJ started tightening. Japanese capital has been sloshing on markets for decades. So I would actually it's a good thing you point that out. We just had June current account data for Japan released overnight, and it showed that there were large sellers of foreign bonds, especially U.S. Treasuries. Now, look, 1 month I think is the biggest sale in nearly a year. Look, 1 month of data is not a lot to hang your hat on, but it's definitely something worth watching. As Japanese yields go up, we should see a natural sort of home bias come back. As domestic yields become more attractive relative to the U.S. and the U.S. is cutting and the rest of the world is cutting, we'll definitely see sort of a rebalancing. So definitely something to keep an eye on. At this point, the flows, I don't think, are disruptive. It's more, I think, the hot money and the carry trade that's doing the volatility, sort of heightened volatility, but definitely worth keeping an eye on.
One to watch. Win, it's great to catch up. Thank you, sir. Win Thin there of Brown Brothers Harriman on the latest in the FX market with dollar yen at the moment. Kind of muted price action, just about unchanged on that currency pair. I guess that's good news for you all. 146.26. We're down on that currency pair by about 1/3%. Let's give an update on stories elsewhere this morning with your Bloomberg brief. Here's Yahara Hackers. Hey, Yahara.
Hi, John. Delta Airlines has been hit by a class action lawsuit. The company is accused of failing to properly refund flyers or provide passengers with meal, hotel, and transportation vouchers after CrowdStrike's software outage last month caused widespread delays and cancellations for the airline. CrowdStrike is also facing lawsuits from consumers and investors over the outage. Meanwhile, investor Kathy Wood is trying to take advantage of the recent stock market sell-off. She scooped up shares of tech firms just as her flagship fund sank to a new 2024 low. Wood's ARK Innovation ETF bought shares of Amazon, Advanced Micro Devices, and Roku. Meanwhile, a fintech-focused fund of her firm also added Reddit and Meta platforms. And Manhattan renters are shifting to smaller apartments in a bid to avoid paying more in rent. The average size of an apartment leased in July was just 945 square feet. That's a decline of 9.5% from a year ago, according to Miller Samuel and Douglas Elliman Real Estate. The square footage has declined on an annual basis in each of the past 11 months, while the price per square foot has risen. That's your Bloomberg Brief. John?
I just realised when Seema Shah said under the bonnet, you guys didn't know what she was talking about. Under the hood.
We've all lived in London.
We say under the hood.
Yeah, yeah.
Okay, but you guys, I mean, like, you know, does that translate?
It does. Well, I love the colloquial phrase, like, there's a bee in your bonnet, which it just sounds so folksy to say, like, under the bonnet.
But that's the hat, right? The bee in the bonnet?
Oh,
isn't that what that is?
Yeah, I guess so. Bonnet means more than one thing?
It means the hood on the... Okay.
Learn something new every day.
Maybe we didn't get it.
I think we've confused ourselves around this table now. So I want to pick up on that story from Miller Samuel. Jonathan Miller had this to say: the lower mortgage rates fall, the more pressure is released from rental market prices. How many times have we talked about this? What's going to happen with the cost of shelter when the Fed actually starts cutting interest rates?
Yeah, well, the fear is they cut. Everyone's like, great, mortgages are going down. Let's get into this market. And supply still hasn't caught up with it. So we could very well be in a world where they cut and prices go up.
It's just not obvious what happens here at all. Up next on the program, when cooling turns to cold.
There's a lot of risk out there to the downside in terms of the labor market. The problem here is when the labor market starts to deteriorate, confidence starts to decline. And when market sentiment deteriorates, that can be self-reinforcing.
Just how self-reinforcing is all of this? That conversation up next from New York. This is Bloomberg.
I think this will probably go down in history as one of, if not the largest financial crimes ever.
I cannot imagine a scenario where $8 billion just disappears.
Bankman-Fried has pled not guilty to multiple fraud charges.
Sam was just too important in the crypto community.
When someone says, I'm going to give $1 billion in the next 2 years, like that catches everybody's attention.
As time went on, their ideas got like weirder and weirder.
I don't think he even had almost a conception at some point that it was wrong or right. I think he just had the mentality that he has to win.
This committee will not stop until we uncover the full truth behind the collapse of FTX.
Sue, Mark.
Are you in? I'm in.
I'm in.
We're in.
Will this be the last of its kind? No. This is the nature of capitalism. Get over it.
From the beating heart of global finance, economics, and politics, and wherever newsmakers are moving markets, Bloomberg brings you conversations that allow for deep discussions and important insights. What do you think the future is for inflation? Is this new normal? Are markets too optimistic? How do you worry about the things that are outside your control? How does the current fighting completely stop? I'm Francine Lacqua, and this is The Pulse, every weekday only on Bloomberg.
Always on the heartbeat of the tech sector.
Spread across global markets.
The real-time data aspect is going to be important.
We're going to bring you expert analysis on that. Sure.
Don't miss Bloomberg's interview with the
Punchy upgrade from Lilly. Eli Lilly seeing full-year revenue 45.4 billion to 46.6 billion. They had seen 42.4 to 43.6. That's the latest on Eli Lilly. That's stock up in the pre-market. Take a look at this, up by 9%. Compare that to Novo Nordisk yesterday. Two very different stories. We'll come back to that a little bit later. The stock doing nicely, though. Under surveillance this morning, when cooling turns to cold.
Looks to me like the labor market is cooling off quite significantly. We've also triggered the so-called SOMO, where if the unemployment rate rises by more than 0.5% over a 12-month period, every time that's happened, we've ended up in recession. So there's a lot of risk out there to the downside in terms of the labor market. The problem here is when the labor market starts to deteriorate, confidence starts to decline. And when market sentiment deteriorates, that can be self-reinforcing.
So here's the latest. A light week of data has all eyes on jobless claims due in about 90 minutes' time. The median estimate in our survey calling for 240,000 claims. Sarah Wolf of Morgan Stanley saying the economy remains on a soft landing path, writing this: churn in the labour market has moderated, indicating that demand for labour is softening. The most recent payroll print showed a meaningful slowdown, but the recent trend remains firmer. We expect the unemployment rate of 4.2% by Q4, 4.5% by the end of next year. Sarah joins us now for more. Sarah, that's a very constructive outlook on the labour market at a time where a lot of people are quite worried about where this is going. Where does that constructive outlook come from?
We have to remember that the employment data is very noisy. So it's not the first time that we've gotten a weak payroll print over the last year, somewhere around the 100,000 marker, just to see it reverse out the next month. So it's very difficult for us to extrapolate forward 1 week payroll print into a hard landing and a 50 basis point cut in September without a string of weaker payroll prints. So if we look back at the recent trend, the 3-month moving average, the 6-month moving average for payrolls is closer to 170,000 to 200,000. It's nowhere near that 100,000 marker. We'll get a lot more clarity on how much of the weak payroll print was weather related. We had a hurricane in Texas in July, and we're going to get that on August 16th, 10 a.m. in the state payroll data. I think that'll give us a little bit of a better sense of how much of the weakness was true weakness or how much of it is weather and is going to be reversed out in August.
Sarah, I want to talk about the self-reinforcing mechanism that Bill Dudley touched on. Let me share that line with you again. The problem is when the labour market starts to deteriorate, confidence starts to decline, and when market sentiment deteriorates, that can be self-reinforcing. But then I look at your outlook for unemployment, falling back to 4.2% by the end of the year, 4.5% from the end of next year. What do you think Bill and the people who think this way at the moment are getting wrong?
I do think that there is some self-reinforcing element. Not only does having a job right now impact how consumers spend, but it's also employment expectations. So if you start to see some people getting laid off, then you start to get more worried about your own job prospects and pull back consumer spending. The reality is, however, is that the unemployment rate is moving higher, but a lot of that is being driven by labor supply as opposed to actual layoffs. If you look